Fed's laser focused on the labor market.
There's some slowing, but it's not contraction. It's not deterioration of the labor market.
These are still numbers that are very constructive for the labor market right now.
Everything's on the table for this Fed. You could get to 25s if the jobs data are good.
The distribution of risks with respect to the labor market are clearly skewed to the downside still, even after this 50 basis point move.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your trading day started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, well off all-time highs. This equity market rally is firmly on pause. And that move continues this morning. We're pulling back by 1/3% on the S&P 500. We're down 0.4 on the Nasdaq 100. We're down by 0.6 on a Russell. Your 24 hours look like this. The next 24 hours critical for the labour market. 8:30 Eastern time, we've got jobless claims. Then it's all about tomorrow, Bramo. Payrolls Friday, just around the corner.
It's hard to make too much necessarily of the pause, and yet it is notable given the fact that we've just had the biggest three-quarter gain going back to 1997 for the S&P 500. How much is hinged on this idea of a Goldilocks cooling but not cold when it comes to the labor market? In other words, how potentially surprised could this market be if growth scares are no longer in the fore, but maybe the idea that the Fed isn't going to deliver on the same kind of rate cuts that many people were expecting?
The rest of the world seemingly leaning towards an easing stance. We've got a bit of news for you from both the UK and from Europe. This from Governor Bailey speaking to the British press. Could become a little bit more activist when it comes to rate cuts. Isabel Schnabel, executive board member over at the ECB. We cannot ignore the headwinds to growth. It looks like maybe the ECB and the Bank of England are preparing to play catch-up here.
The Bank of England saying that as long as inflation data remains good, they can keep on cutting rates more aggressively. Isabel Schnabel was the hawk on the committee, the person who wanted to say, look, inflation's still a concern. For her to come out and basically pave the way with a gilded rate cut, certainly this month, if not going again, raises the question, is the ECB going to be so far behind the Federal Reserve by the end of this year when it comes to how many rate cuts they've implemented?
The euro a touch weaker, the pound a whole lot weaker. We'll pick up on the sterling story a little bit later this hour. Need to pick up on crude as well. 3-day rally on WTI and Brent. The scores look like this. AMH 75 on Brent, WTI just short of 72.
The market is really just waiting for Israel's response. And when you look at this Axios report, they say officials in Israel say there's going to be significant retaliation and it could target oil production facilities. Halima Croft put out a note yesterday talking about, well, where are Iranian oil facilities? How much are they producing? They're exporting right now about 1.7 million barrels a day. So that is really the concern right now in the oil market, even though we talk about the fact that there is a lot of supply, there's spare capacity, and China's demand isn't quite up to speed. This geopolitical concern, the fact that there could be escalation, is starting to add a little bit more of that risk.
Some people are saying, what took them so long? It seems like this has been percolating for quite a while. Why haven't we gotten more of this kind of response in the oil market? What I find interesting, putting aside the potential escalation and the oil market dynamics, is how this has affected the bond market. The fact that suddenly this has reintroduced this question of, are bonds going to act like a haven asset in the case of some sort of oil disruption, given the fact that could raise the specter of noisy inflationary pressures, at least in the short term?
Always highly dependent on what the central risk is. If the central risk is higher crude prices and higher inflation, you've got a very different story in the bond market. I think what we need to get our hands around this morning, and we'll speak to Citi a little bit later on, how many barrels are actually at risk here? If you go after energy infrastructure in Iran, we're not just talking about Iran. Aren't we talking about compromising the whole Strait of Hormuz as well?
Well, yes, and not only that, what does this mean in terms of the Iranian retaliation? Will they go after regional players? Will they go after potentially oil facilities and some U.S. allies in the region? That is why there's a concern. Does this become a tit for tat within the energy space?
Brent crude right now, 75.21. Coming up this hour, this is what your lineup looks like. We'll catch up with Matt Miskin of John Hancock ahead of fresh labour market data this morning. Stephen Cook of CFR on Israel's next move. And Jordan Rochester back in the sea over at Mizuho. We'll speak to him as yen weakness makes a big comeback. We begin this hour with global equities heading for their first weekly loss in 4. Investors are waiting jobless claims at 8:30 Eastern ahead of payrolls tomorrow. Matt Miskin of John Hancock writing the US City Economic Surprise Index improving likely means we step back from 50 basis point rate cuts to the next Fed meeting. Powell hinted at this in his recent speech. Matt Miskin, I'm pleased to say, joins us now for more. Matt, this market rally is broadening. Do you think the data and the earnings that are still to come will validate this move?
We actually don't believe that this data is going to be that strong. I think that the Fed is going to have to go back from saying 50 basis points. I mean, Powell has communicated this. He's done a really good job at it, actually. He was like, don't expect 50 basis points per meeting. And then this week, he's like, look, it's going to be more likely 25. That's what we put in the summary of economic projections. And as Lisa has been saying, the data is getting better. So he's likely going to have to pull back on the dovish tone. To us, that's going to mean the market's not going to be as happy about this. And we're probably going to continue to see chop. The last time in 1997, we had 3 great quarters like this. October was a tough month. So we actually expect some volatility here near term. We think there's going to be some stuff to look at in the bond market in particular, to look at as opportunities. But near term, some volatility may be in store here.
Matt, just to be super, super clear, going into payrolls tomorrow morning, are you saying good news might not be good news?
Unfortunately, we're back in the future, or back to wherever that was. It's a phase where good news is bad news. But I think that the bond market had priced in so many cuts. And the near term, it was overly optimistic on the cut scenario. I think actually yields could come up a little bit. It'll be a buying opportunity for long-term investors. We would look at it as an opportunity. But you also have other things. You have the geopolitical risk. You have the port strikes. You have all these inflationary pressures. And it's too soon for the Fed to go back to saying, hey, this could be transitory. Too soon. Too soon. You can't be like, they already got burnt on transitory before. You can't say, well, we've got all these inflationary pressures near term. We're just going to overlook them. I think they have to actually be a little hawkish here in the short term.
Other people who share your view, Matt, I'm thinking of Ed Yardeni, for example. I'm thinking of Torsten Slok, also see equity outperformance. They also see that this positivity, this better than expected economic data will support riskier assets at the behest of bonds that might actually struggle or be range bound. Your view is actually kind of the opposite, the idea that it is time to go into bonds and be much more cautious when it comes to risk assets. Can you explain how you come to that conclusion?
Well, a lot of good news is priced in. I mean, the valuations here, you're looking at 21 plus times. On a trailing basis on the S&P 500, we're at 26 plus PE ratio. Typically, after 26, you go to 27. There's never been a 10-year return that was actually positive from that level. We're already at peak valuations. Broadening of the market. I didn't think broadening of the market was going to be Chinese equities going up like a hockey stick, but that's where we are. And it's a bit of that hot money. You know, we're seeing these signs where it's hot money is running around. Maybe it's YOLO capital. But at the end of the day, this hot money is not actually a sign or a symptom of healthy kind of market behavior. And if you get some geopolitical risk, you get some inflationary pressures, you get some hawkish Fed, I actually think that means short term, some corrective price action.
I look forward to the movie Hot Money Running Around. I am wondering, though, about the idea of China. You're talking about how that's the broadening out that people weren't expecting. There are a couple of leading economists in the region who are expecting some $1.4 trillion of additional fiscal stimulus, given the needs and given the reception to the bazooka that has been unleashed so far. At what point is this no longer hot money? At what point can you look at some of the fiscal stimulus and say, this isn't just tourism, but something fundamentally that has changed?
It comes back to earnings, Lisa. And at the end of the day, earnings in Chinese equities are where they were in 2011. So it's been over a decade and earnings growth has gone nowhere. The multiples in the Chinese equity market has really risen as of late. It's all been multiple expansion. But at the end of the day, that's why the S&P 500 and U.S. equities have been the dominant equity market, is because the earnings growth are the best in the world. It doesn't matter if you're a small cap stock, a value stock, a Chinese stock. It doesn't matter where you are. At the end of the day, earnings growth is what drives equities. Stocks follow profits. It's really simple for us. That's what we talk to our clients about. But at the end of the day, Chinese equities need to break out on an earnings basis, and they're still caught really where they are for the last decade. And until we see that, we frankly think that this is more of a value trap and hot money chasing kind of stimulus headlines than a fundamental change in the market.
Matt, can we go back to the jobs picture? Right now, the United States basically has 2 domestic issues that is going to affect the job market, the hurricanes and also what's going on with the dock workers. I'm more interested about the November 1st report that's going to look back on October. What are you expecting?
Yeah, a lot of noise. Yeah, great point. I mean, as if the Bureau of Labor Statistics jobs report was this kind of quality data point. I mean, the revisions have been massive overall. You've had to go back over a year and rechange a lot of the data. Every month is revised. And then you've got all these different, maybe it's one-off events or kind of, shorter-term events that are probably going to really cause a lot of data issues. And it makes it's almost like, you got a blindfold on as it relates to the Fed, because then you're trying to make policy based on the employment data, which is the most important thing they're looking at right now. But the ADP report was a bit better. Initial jobs claims have been low. I think you have to bake in that there's going to be some lower quality elements to the data in the next couple months. And it's a tough time to really be, hey, we're going to take this with a grain of salt. We can't really be super confident in the data because it's a pivotal time for the Fed to really stick the soft landing. If they really want to do that, we think they got to cut aggressively. And the data is not going to be very easy for them to follow.
So does bad news on November 1st potentially mean another 50 basis point cut?
I think so. Yeah, I think if the jobs data does diminish, I don't think they can give that, excuses to say, hey, well, there's this and that and the other thing. I think they have to go ahead with the 50 basis point cut. But I mean, we're going to have a lot of data across the board. The quit rate in the JOLTS report is dropping off a cliff. You could see, the Conference Board's consumer survey, you could see basically jobs hard to get, keeps getting harder and harder to find. So it's all in the mosaic of the jobs data. But if you've got a couple bad reports, I don't think they have the ability to kind of brush that off. I think they're going to have to cut.
Hey, Matt, appreciate it. Matt Miskin there. John Hancock going into payrolls tomorrow morning at 8:30 Eastern Time. I think a lot of people have come on this programme in the last few days and put even more weight on the October report and even less weight on the September report that we get tomorrow morning, primarily because there's going to be a lot of disruption in the next month. And it's going to be very interesting to see whether this Federal Reserve comes out ahead of time and sets up this market to look through what could be some real weakness.
And which way do they look through it? In other words, do they err on the side of cutting much more aggressively, or do they err on the side of being more tepid, of going 25? And that also will tell people where the bigger concern is and where they're putting sort of their thumb on the scale when it comes to the size and speed of the rate cuts.
The median estimate in our survey, 150K. The previous number, 142. Futures a little bit softer this morning with an update on stories elsewhere. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. The European Union reportedly has enough support to impose definitive tariffs as high as 45% on imported electric vehicles made in China. According to Reuters, France, Greece, Italy, and Poland will vote in favor of the tariffs, likely giving the EU enough support to pass the vote. The support comes despite the risk of potential retaliation from Beijing. The EU's 27 member states are expected to vote on the measure tomorrow. Staying on EVs, Toyota is pushing back plans to start making its first U.S.-made electric vehicle. The Japanese car maker initially targeted late next year to begin production on the EV, but a company spokesman says that has slipped by a few months into 2026. This coming as demand for battery-powered vehicles has slowed. Still, Toyota says it's committed to making a battery-powered SUV at a factory in Georgetown, Kentucky, and says it plans to sell as many as 7 EVs in the U.S. within the next 2 years. And it's time for China to unleash a fiscal bazooka. That's according to Jia Kang, a leading economist in China. Kang says the country has room to ramp up fiscal support for the economy by issuing as much as $1.4 trillion in special debt, underscoring growing expectations for Beijing to expand public spending as part of its stimulus package. The Economist thinks the issuance could lift confidence by drastically raising government investment in public projects. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Woke up in shock, looked at the Hang Seng, and it was an odd colour, the colour red. Hang Seng Enterprise Index snapping a 13-day rally in today's session. Over that period, we're talking about gains of more than 30%, 30 over that period.
How many notes have you read saying we're tourists? We're not necessarily committed. We're not exactly settling into Chinese
Trade,
equities.
not an investment.
Exactly. And that's basically what you felt. People saw the 30%. They said, ka-ching, we'll hold that, and then we'll wait to see what else is next.
The Hang Seng down today by 1.5%. Up next on the programme, a man-made disaster.
This natural disaster is incredibly consequential. The last thing we need on top of that is a man-made disaster. What's going on at the ports? We're getting pushback already, and we're hearing from the folks regionally that they're having trouble getting product they need because of the port strike.
The latest on the strikes up next on the program, live from New York City this morning. Good morning. This rally stalled. We're down about 0.4% on the S&P 500. There's a growing sense, though, that once we get over these near-term hurdles, this rally can carry on. Goldman Sachs, Scott Rubner. I'm bullish on US equities for a year-end rally starting month-end. I'm worried that my 6K target is too low. In the bond market, yields high by 2 basis points. The 10-year 380.56. Under surveillance this morning, a man-made disaster.
This natural disaster is incredibly consequential. The last thing we need on top of that is a man-made disaster. What's going on at the ports? We're getting pushback already, and we're hearing from the folks regionally that they're having trouble getting product they need because of the port strike. The owners are making tens of millions of dollars in this. The last thing they need is some profit off of this. It's time for them to sit at the table and get this strike done.
So here's the latest. President Biden upping pressure for port employers and shipping lines to reach a deal as every major container port on the Atlantic and Gulf Coast remains shuttered. He joins Vice President Kamala Harris in blaming the shipping companies for the disaster with the election just around the corner. Bloomberg's Katie Lyons joins us now for more. So, Katie, let's start here. How far apart are these two sides?
Well, on wages, John, according to the Transportation Secretary, Pete Buttigieg, they're not that far apart. Of course, before this strike actually began on Monday, the U.S. Maritime Alliance put an offer to the union that they would raise wages by 50%. What the union is actually looking for is a 77% raise over the 6 years of the contract. They want the starting rate to be $5 above what the final year six term was in the contract that just expired. That would be $44, and they want it to go up $5 for each year, ultimately culminating at $69 an hour by the final year. And what the union leader wants is that wage agreement to be a precondition for a return to the bargaining table. The two sides aren't talking right now. It's unclear when exactly they're going to be back at the table once again to discuss what the other issues are that the union would like to see resolved, which, of course, deal with things like automation or even semi-automation at these ports. That is potentially a thornier issue. Wages is one thing, but the other parts of this negotiation that wages, the union says, would unlock could be a lot more difficult, and there could be further distance between the two sides on those issues.
Katie, that's a pretty substantial wage increase, especially when you look at what they're making right now. With overtime, most of these individuals are making over $100,000 a year, and some even north of $200,000 a year, according to reports, when you lock in overtime. So does the issue really come down to automation and that language in this contract?
Yeah, the union says they want ironclad guarantees around automation and that language is incredibly important. But again, to get to the actual nuanced argument around what the language of a contract will be, the union is saying you have to meet those wage demands first. And what they say about that, those higher end earners of these dock workers is that they have to work incredibly long, difficult hours in order to actually make that kind of money. So they want that factored in to consideration here. All that said, as you talk, Annmarie, of this notion of that this is pretty sizable increases, what they would point to, what President Biden is pointing to, is he still is on the side of the union here when he's talking about a man-made disaster. He's really putting the blame at the foot of the men and women who control these shipping companies. He says their profits went up 800% during the pandemic, and that workers deserve a fair share of those profits. So he wants to see collective bargaining as the mechanism for making that fair wage increase happen, which is why this White House is still maintaining they will not be invoking Taft-Hartley to stop this strike, even as we get closer and closer to Election Day.
And another salvo for those companies. President Biden yesterday saying that he directed his team to monitor any, quote, price gouging that he thinks these carriers could be going after. So Joe Biden has come out and always said he's Union Joe. Tim Walz at the debate yesterday said, hey, I'm a union guy. How is Kamala Harris talking to the unions?
Well, she has been really trying to align herself with this administration she's been in for the last 3.5 years, describing them as a pro-union administration. She has made it very clear that she would not be changing the tune of President Biden when it comes to being on the side of organized labor. And we're actually seeing her today traveling to states in which organized labor is incredibly important. She'll be spending most of the day today in Wisconsin, then traveling to Michigan. These are these blue wall, Rust Belt states in which blue collar workers and union workers are incredibly important as she tries to secure them in order to win the Electoral College. So this is a very tricky line for her to dance here. She does want to be pro-union, but potentially when the effects of this strike really could be felt, which broadly economists think won't be for several weeks, as a lot of companies brought in supply in anticipation of this potential strike in advance. It'll be a while before shortages are really visible to the American people. That obviously could create a problem as that brings us closer to the election day, but she also doesn't want to alienate the labor vote.
Kayleigh, Biden talked about this as a man-made disaster. It was in contrast with something that was not man-made in any way, shape, or form, and that is the devastation that you're seeing in southern states as a result of Hurricane Helene. There has been a focus on getting federal funding to cover almost all of the spending. Some estimate that the cost of the storm could be $160 billion. Just even the agricultural losses could be $7 billion alone. How difficult is it to get the federal government to release this funding in short term at a point where this is just contentious, the idea of spending and where this is going to come from?
Well, the emergency money can come a lot quicker given existing authorities. So where the emergency declarations, disaster declarations have been made, that money is already flowing. I actually spoke with Pete Buttigieg, the transportation secretary, earlier this week, who said looking at infrastructure that has been damaged, the transportation department does have money ready, sitting and waiting to be deployed once the actual just cleanup is over and they actually start looking at repair and recovery. That said, this White House has made it clear they could potentially need to put in a supplemental funding request for Congress, because you're absolutely right, Lisa. When visiting the disaster areas yesterday, Harris in Georgia, Biden in North Carolina, each of them respectively announced 100% federal cost share for what the recovery is going to cost. Once we know what that total dollar figure is when we'll know how much Congress is going to need to be involved here, with the reminder that Congress is not currently in session and not scheduled to be back until after the election. Now, members of the House, of the Senate from these states that were affected by this disaster have called for them to return to address this. It's just unclear at this time whether leadership is going to adhere to that and they'll come back to Washington.
There are 33 days left, I believe, maybe even less at this point, until the election. And there are a number of issues, whether it's the strikes at the docks, whether it's what's going down in the southern states, whether it's the potential for the Middle East conflict to potentially send oil prices higher that could cause a real shift in the economic backdrop heading into the election. What's the level of concern among people who you speak to about that?
Well, it's October, Lisa, and there's always room for surprise. We got at least 3 of them just in the first few days of October here. So certainly that is a risk, especially when it comes to those factors that you're rightly pointing to could affect the economy. Democrats I speak with are very encouraged by the fact that Kamala Harris has been polling better on the economy, not just relative to Joe Biden, but relative to Donald Trump as well, with her in our latest Bloomberg Morning Consult swing state poll trailing him on the overall issue of the economy by just 4 points and actually leading him in some areas when it comes to things like housing and helping the middle class. The concern is that if we start to see a more material turn in the economy or inflation would spike again, people are faced with higher sticker prices at the grocery store, higher gas prices at the pump, that could then deteriorate sentiment. Obviously, a lot of economic feeling right now, maybe largely baked in with less than 5 weeks to go. But if there is a material change in that, as voters get ready to head to the booth on election day, it is seen that the incumbent administration, which includes Vice President Kamala Harris, could feel the most direct blame for that, and that could be something that is problematic. On the other hand, those foreign policy related issues that could lead to, say, a higher spike in oil prices, the fact that she has been in the Situation Room is something she and the White House have been playing up this week, trying to essentially make her look like someone who could be commander-in-chief. So while there could be some advantages, certainly disadvantage could come with it, too.
Kelly Lyons, appreciate the update down in Washington, D.C. from the nation's capital on some of the difficulties facing this country right now. Coming up on the programme, Stephen Cook of CFR on the military response. Israel is vowing against Iran. That conversation just around the corner. Equity futures on the S&P down 1/3% from New York. This is Bloomberg. Jobless claims 8:30 Eastern Time, then 24 hours later, we'll get payrolls in America. Equity futures on the S&P 500 pulling back by 1/3%. The view from Bank of America, the risk is to the upside, absent a big miss. We think slight weakness may be overlooked by investors and only sizable misses reignite recession fears. We're pulling back nevertheless. We're down by 0.7% on a Russell 2000. If we switch up the board and get to the bond market story at the front end of the curve, the 2-year in the 360s, which is where we've closed all week so far. The low to mid 60s, 365.80, Lisa, on a 2-year, up a single basis point.
A number of different research pieces that I've been reading highlight how range-bound is sort of the new normal, because basically the upside and the downside is relatively balanced. That's what a lot of people are feeling. A lot of people expecting that probably we have seen the bulk of the rate cuts being priced in. Now the question really is just how good or bad is the economy? To your point, normally in September, we see a volatile negative month. We saw the best September returns going back to 2013 for the month. Basically, people snubbing their nose at this idea that it's seasonality.
Yields up by a couple of basis points as well on a 10-year, in and around 380.75. Let's turn to foreign exchange. This one stands out. 3 days of sterling weakness. Cable, 131.16. If we closed here right now, it would be the biggest one-day loss going back to March 2023. Governor Bailey speaking to the Guardian newspaper. The quotes coming out of that suggesting he's ready to get a little bit more aggressive and inflation heads in this direction.
Because he said he's going to get a bit more aggressive if they end up with inflation staying where it is. Key question here is how much of this means that the Bank of England and the ECB, for that matter, will be actually on par with the Federal Reserve. Everyone was expecting the Fed to move much more aggressively, but is it really maybe the flip side, that it's going to be more on par and you might actually see a little bit more dollar strength after a pretty steady streak of dollar weakening?
This is the UK, particularly also for the ECB and the European economy. Europe is really struggling. We talked about Isabel Schnabel a few times already this morning, the executive board member of the European Central Bank, really highlighting weaker growth on the continent, which has been clear for the rest of us for quite a while, but hasn't come up on the ECB's Governing Council meeting, according to the news conference we've been getting, in a big way.
What's shocking to me is that they were talking about weakening growth. We could all see it. We've all read about it. It's been visible in the data. But the inflation rate hasn't been that high, and now we saw it fall below that 2% level across the euro region in places like Germany and places like Spain. And you have to wonder, what else do they need? If they're a single mandate central bank, they have that single mandate as well.
There's a big energy component in all of that, but certainly the trend is lower inflation across the continent, at least for now. Under surveillance this morning, our top story in this country, catastrophe modelling. The firm, KCC, estimated the destruction from Hurricane Helene will cost insurers $6.4 billion US. President Biden and Vice President Kamala Harris touring parts of the southeast and announcing steps to bolster recovery efforts, with the death toll rising to 166 across 6 states.
Devastating photos as the president was surveying the area yesterday. 2 main issues remain that are really top of mind for a lot of these governors. One's that safe drinking water. You can't have kids go back to school without safe drinking water, and also power. Still, more than 1 million people without power in a lot of these states. I caught up with someone from Governor Youngkin's office yesterday and talked about the fact that this major disaster declaration they received from the federal government was the first time for Virginia since Hurricane Irene in 2011, trying to put into context just how bad this is. And they were saying, look, it's communities of 200, 300 people being washed away. And they feel like actually, that's why there hasn't been as much coverage of what is going on in these southeastern states.
Also communities across this country, particularly in places like North Carolina and Tennessee, that you wouldn't typically associate with scenes like this.
That's part of the reason why a lot of people weren't insured. You think about $6 billion of insurance costs. That's actually nothing, a pittance relative to the $160 billion of potential damage. You have to wonder, people living in some of these smaller towns saying, why should I take out flood insurance and spend an extra $6,000 a year for flood insurance? What's the likelihood? We're not on a coast. We're not in a hurricane zone. Why would we get flooded out? And yet that is what happened with the tides rising and with 3 feet of water dropping across the entirety of Tennessee, as we learned the other day.
Especially when insurance in this country right now is certainly more expensive than it has been over the last few years. Let's get to the drama over in Europe. The EU preparing to vote tomorrow on imposing tariffs as high as 45% on Chinese-made EVs. Reuters reporting the measure has enough support to pass, with France, Greece, Italy and Poland expected to vote in favour of it. Germany indicating it plans to abstain.
That's a U-turn from what the German foreign minister, Annalena Baerbock, said to me. She insinuated in my question that Germany was not for these tariffs, that I was wrong. So I asked her point blank, so are you on board? She said, yes, of course, obviously. But then she did go on to say, but again, the world is not black and white. We have to look at different car companies. If a car company is producing and doesn't get unfair subsidies, then obviously the tariff should be imposed differently. The issue is the German government and the German auto sector are miles apart when it comes to how they deal with China and dumping on the EU market.
So let's get into it. Is this because they don't think it's the right policy, or they're just scared of offending their Chinese counterparts? What's this about?
For the car companies, if you ask them, they are very clear about it. Some half of their sales are in China. Some significant proportion of their overall business comes from the world's second biggest economy. This is something they don't want to play around with because their business model would fundamentally shift if China really put up the gates in terms of European automakers selling into that country.
We'll be covering this story tomorrow, no doubt. We'll be catching up with Bloomberg's Ollie Crook, I hope, out of Berlin on this story. Let's turn to Israel striking Beirut after 8 of its soldiers were killed in southern Lebanon in battles against Hezbollah. The world awaiting Israel's response to Iran's missile attack, with President Biden urging Israel to hold off from attacking Iran's nuclear facilities. Bloomberg's Jumana Basechi joins us now out of the region in Dubai. Jumana, can you walk us through possible targets? There has been a bigger conversation, a broader conversation more recently about the prospect of targeting energy infrastructure. How realistic, how likely is that?
Well, it seems pretty clear at this point that a reprisal is coming. Some of the options on the table could be targeting military infrastructure, similar to what happened back in April when Israel went after specific air defense battery that was a very targeted strike, but then it ended there. This time around, there's a feeling that the response will have to be more forceful, and it could take the route of even covert operations targeting specific IRGC commanders. But then the other option being discussed, as you mentioned, is targeting energy infrastructure. So just to give you some numbers here, Iran produces about 3.3 million barrels per day of oil. About half of that is consumed domestically. Now, if Israel wanted to inflict economic pain on Iran, but without causing a massive spike in the price of oil, one option is to target specific processing refineries, where there's one refinery on the Persian Gulf that accounts for about 50% of the gasoline that is consumed domestically within Iran. That would take out about 400 to 500,000 barrels per day. So the impact would be quite astute for Iran, but not necessarily when it comes to global oil supply. So something to bear in mind there. And that, of course, is one of the options being discussed. And then quite literally, the last option is the so-called nuclear option, where Israel would go after some of the nuclear sites around Iran. Operationally very difficult, would entail coordination with the U.S. And also it's unclear at this point whether Israel actually has the military capability to take out these nuclear facilities and limit their ability to function in a meaningful capacity. And add to that, U.S. President Joe Biden was asked about it yesterday, and he said while he supports Israel's right to respond, they would not support them attacking these nuclear sites. So it seems as though the other options will be more likely.
Quite literally, the nuclear option. Jumana, thank you. Jumana Basechi out of Dubai on the latest there. Stephen Cook joins us now, Senior Fellow for Middle East and Africa Studies at the Council on Foreign Relations. Welcome back to the programme, Stephen. We'd love your early indication, your thoughts on where you think this is going. If you have an idea of what retaliation actually looks like, Jumana went through a series of potential targets. How are you thinking about retaliation?
All of them. I think that the Israelis are not going to limit themselves one way or the other, and they're clearly not listening to the President of the United States. I think there's a menu of options for the Israelis that include economic sites, leadership sites, military sites, missile sites, up to and including the nuclear program. I don't think the Israelis can hope to destroy Iran's nuclear program, but they can make a big point by hitting parts of it. I would remind everybody that it is the only country that has ever engaged in non-proliferation by force is Israel in both Iraq and Syria. So there is precedent for them to hit nuclear programs. I think that the fact that there were 181 ballistic missiles fired at Israel from Iran really puts us in a much, much different situation than we were last April. And the Israelis are going to make a very, very strong point. And so I think many of those sites that are under discussion may be hit, and they may be hit simultaneously.
Stephen, yesterday the president said that Israel has a right to respond, but they have to respond proportionately. Does Israel respond to the intent of destruction that Iran do, or do they respond to the destruction that Iran actually got to? Because in the end, they didn't really destroy much. All of this was struck down.
Yeah, I think that there was probably more damage than the Israeli censors are letting us know. But nevertheless, I think that regardless of what the president of the United States says, and I know that that's an extraordinary thing to say, it's been clear that the Israeli government hasn't really been listening to President Biden for quite some time. We're also in this interregnum 5 weeks before a presidential election. So I think that whatever the president, whatever people are saying in Washington about proportionality, the Israelis are going to choose their targets as they see fit in line with the point that they want to make and the damage they want to do to Iran's ability to threaten Israel's security. So that puts Iran's missile forces, military bases, IRGC headquarters, energy infrastructure, and like I said, even possibly the nuclear program in Israel's crosshairs.
You mentioned the election, so I just want to get your take on what Secretary of State Antony Blinken wrote this week in Foreign Affairs. Quote, the Biden administration's strategy has put the U.S. in a much stronger geopolitical position today than it was 4 years ago. Is he correct?
Well, it's hard really to make that case, particularly in the region which I focus on. That's not to suggest that the instability in the region is directly related to the Biden administration's policies. I think the self-deterrence that the United States has been engaged in throughout the Biden administration is something that the Trump administration also engaged in, and something the Obama administration before it engaged in. I think this has been a bipartisan affair in which the United States has looked at the malign activities and chaos that Iran has caused throughout the Middle East and decided to respond in kind of minimalist ways, calling for de-escalation, not willing to take on Iran directly. Now, I'm not saying that that we should have gone into Iran and engaged in regime change, but through all of these years, the Iranians have thus been able to build up Hezbollah, build up the Houthis, to the point that the Houthis now have leverage over shipping in the Red Sea. That's a very serious geopolitical problem for the United States and its partners around the world. So I would say, in all due respect to Secretary Blinken, when it comes to the Middle East, certainly the United States is not in a more advantageous geopolitical position.
Given everything that you just mentioned, what does a broadening out in this conflict look like? I've been struck by the fact that we haven't heard much from Saudi Arabia, from Jordan, from Egypt, even from the non-Hezbollah government from Lebanon. A question of which other countries will get involved, who will align with Iran, given that Russia is otherwise occupied, and who's going to align to counter Iran?
Well, it's clear that our partners in the Gulf are not unhappy with the damage that Israel has done to Hezbollah. I think all of these governments would agree that the Middle East would be better off without Hezbollah and without Hamas. I think they've been frustrated by how long and the methods in which the Israelis have used, particularly with regard to Hamas. But nevertheless, they're not unhappy about this development. The question is whether they will get directly involved. To some extent, they have been by their integration into CENTCOM, providing technical data to the United States that is then passed on to Israel when it comes to these types of ballistic missile attacks that the Iranians have engaged in both April and most recently a few days ago. But the Saudis and the Emiratis and others have signaled that they do not want to be in the middle of an Israel-Iran war. Now, geographically, they are, but Dubai is quite vulnerable to Iran's missile strikes. So is Riyadh. And as a result, the Emiratis and the Saudis have been positioning themselves as a conduit between the Iranians and the United States, and by association, Israel in this whole episode. I think that this is essentially a conflict between Israel and Iran, and Israel can expect support from the United States, technical support from Arab governments, but not high-profile support. And there might be some support forthcoming to Israel and the United States from European powers like Great Britain and France.
Stephen, one just quick final question, and forgive me, it could be the title of an essay, so we don't have that much time. Can you tell me why it's been so difficult for America to establish deterrence in the region, why that's been so elusive over the last year?
It's our hangover from Iraq. We went into Iraq without, let's just put it this way, it was a strategic blunder. And now foreign policy policymakers have been quite careful about the use of force, even when, unlike Iraq, the use of force is warranted.
Stephen Cook, thank you, sir. Appreciate it. Stephen Cook of CFR. We'll catch up with you soon, no doubt. If you are just tuning in, welcome to the programme. Equities just a little bit softer off the back of that conversation on the Middle East. Crude is higher for a third consecutive day. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Warren Buffett is still selling Bank of America stock, but not as much as before. Buffett sold $338 million worth of shares this week, a sharp drop from earlier rounds where he sold about $750 million worth of stock per sale. Buffett hasn't said why he's cutting back on Berkshire's massive stake in the bank, but even then, the conglomerate still ranks as the top Bank of America shareholder. Meanwhile, SoftBank founder Masayoshi Son is outlining an aggressive timeline for the adoption of AI. Son claims the technology will be able to run entire households in only a few years' time. According to him, AI will soon be able to do things like monitor the health of family members, do the grocery shopping, make reservations, and much more. Son, of course, is known for making bold calls that have led to big wins, but big losses as well. And Eli Lilly's blockbuster weight loss and diabetes drugs are officially back in stock in the U.S. The Food and Drug Administration announcing the shortage of Lilly's Zepbound and Mounjaro is over. The agency also warning knockoff drug makers that there are legal restrictions on making copies of FDA-approved drugs when there isn't a shortage. That's a blow to compounding pharmacies that have been able to capitalize on the limited supply of the medications. That's your Bloomberg Brief. John.
Yahara, thank you. Up next on the programme, yen weakness back in the spotlight.
I think that the moves from the Japanese currency were very much based on questions over policy continuity in Japan under the new Japanese administration and the administration's direction towards monetary policy.
The worst day for the Japanese yen in more than 2 years. That conversation up next with Jordan Rochester of Mizuho. Live from New York, welcome to the programme. Stocks pulling back by a third of 1% on the S&P 500. Yields up 2 or 3 basis points on a 10-year, 380.75. Under surveillance this morning, yen weakness back in the spotlight.
I think that the moves from the Japanese currency were very much based on questions over policy continuity in Japan under the new Japanese administration and the administration's direction towards monetary policy. Any kind of market volatility for the Japanese yen is likely to die down in the coming months.
So here's the latest this morning. The Japanese yen coming off its worst day in more than 2 years as Japan's Prime Minister suggests the economy isn't ready for more rate hikes. Jordan Rochester of Mizuho looking for more of the same. Long yen is a very consensus trade. That may need to be unwound with higher oil and less Fed cuts priced. 148 is possible later this month if oil remains bid and NFP comes in line or better. Joining us now is Jordan Rochester. Jordan, welcome and congratulations for a new seat, for a newborn baby and for Aston Villa. I noticed the tie, and not necessarily in that order. Let's talk about this, Jordan. Dollar yen. Tell me if we need the endorsement of the Japanese Prime Minister for the BOJ to make another move.
You don't need the endorsement, but it would help. There's been a lot of changes on the political front, new prime minister and new policies. So there's some pushback on this rate hiking cycle from Ishiba yesterday. Combine that with the dollar yen move, John, because you saw such a huge move lower in dollar yen over the summer that it actually could knock off quite a lot from Japanese inflation from the goods sector. A simple chart of just FX moves versus headline inflation of goods, that's 1% off the headline rate of CPI from the FX move alone. And this is a tepid recovery in the Japanese inflation story. I think structurally the domestic data suggests that the BOJ should be hiking. However, the politics with an election coming up and those moves in FX mean the near-term October-December meetings quite unlikely we get that rate hike. January is still possible, John, but you need a weaker yen to make it easier for the Bank of Japan when it comes to their inflation forecast to do so. And it gets a bit circular, because BOJ hikes equals a stronger yen. So that's why you see these big narrative shifts. I actually think there will be a lot more volatility in dollar yen as we go into year end.
Well, from a risk perspective for international markets, Jordan, how ring-fenced is this story in Japan?
It's definitely not ring-fenced. I mean, the wage story is what makes me confident that the BOJ should be on the same setting as they were, talking about a very gradual, every 6 months or so rate hiking cycle. We're just talking up to a terminal rate of 75 basis points to 1%. So it's not aggressive like you saw in the Fed or the Bank of England or elsewhere. But if you have domestic developments, so if you have a global recession, if you have yen strength, they don't actually need to hike because that will do a lot of the work for them. So it remains very much market dependent, market state dependent. If dollar yen was at 160, for example, it'd be very easy for them to go ahead with the rate hiking cycle, John.
That said, Jordan, just to build on what John was getting at, back on August 5th, there was this carry trade that a lot of people attributed to this incredible spike in volatility across asset classes because of how much leverage was built up in that. Has that been unwound, or has that been built right back up as people realize, all right, maybe we're back to square one here?
In the banking flows, you could suggest it hasn't been completely unwound. It takes a bit of time. But in the FX and sort of rates flows, it was not just unwound, it was taken the other way. So we went from a massive yen short. So it became very clear when you had that yen positive news in August with the rate hike. And you also had softer US data with NFP and the SARM rule being triggered. You had massive deleveraging of that carry trade in the FX space and in rates. And then it went through to massive yen longs. So that's kind of why we're seeing yen under pressure over the past couple of days, with the idea of the politics becoming a bit more harder for the Bank of Japan to do that rate hiking cycle.
When you look at positioning, one thing stands out, and that is the short position on the dollar. This expectation, broadly, a consensus, that the dollar will weaken as the Federal Reserve cuts rates. We've seen a shift in that over the past couple of sessions, with the longest streak and the biggest streak of dollar strength going back to earlier this year. I wonder, Jordan, do you expect that to continue, given the fact that suddenly it is more feasible to see the ECB and the Bank of England act more aggressively?
I tell you what will continue, this mean reversion we've seen in the dollar and the sort of narratives in the market. And that's because the central bankers are so data dependent. You get 1 month's hot NFP print or 1 month's soft print. It changes the narrative from the Fed, and therefore you have dollar reverse everything it did over the previous month. So in answer to the question, I think that the dollar strength that we've seen is on the back of better, harder data. So initial jobless claims has been healthier in the past couple of weeks. I think the NFP will probably be in line at 4.2%. And then the dollar strength can continue in October. Then we get to next month's print, and then we'll have the impact of Hurricane Francine, the impact of the Boeing strikes, and who knows, we might have a soft NFP print. And it will feel like, for you guys who have to listen to people talk about this every day, very hot and cold, very flip-floppy. And I'm just a man from Birmingham trying to understand that I think the US data is better than Europe and the UK. And I think the European central banks have been way too hawkish compared to the Fed, who've been slightly too dovish, really. And that makes an easy trade for me, being looking for short euro and short sterling expressions versus the dollar.
Well, you're an outsider looking in. When you're in the United States and you see local reports based off the docks, people are starting to hoard toilet paper, you start to think a little bit differently about what's going on. So when you start looking through potentially this messy payrolls report in November, what does that mean for the dollar? Does that mean bad news, potentially good news, because it could mean the Fed cutting 50 basis points?
It could be bad news for the dollar if you get a sort of dovish response from the Fed from that unemployment report. What we've seen over the past few days is higher oil prices thanks to Israel, Iran. We've seen pretty healthy JOLTS figures out the US, and we've seen a repricing of the market for the next Fed meeting. The idea of 50 basis points has been reduced. We're getting close to something like unlikely in terms of market pricing now. It was quite the consensus just a few weeks ago. If we get to the next NFP print, it's one of those weird Fed meetings where they have the luxury of 2 NFP prints in a row. So if you have a good one tomorrow, and if you have a bad one next month, it will make it a 50-50 toss-up whether the Fed does that 50 basis points. The problem is it will come during the Fed's blackout period. We won't be able to hear much from them during that window. We'll have to listen out for Nicky leaks at the Wall Street Journal.
Jordan, how good did last night feel? I'm just a man from Birmingham. I'm just a man with family from Birmingham. Jordan, how good did last night feel for Aston Villa?
I think the streets of Birmingham were electric last night. You heard it in the stadium. What a win, historical. I couldn't be more prouder of the team. Hence why the Villa tie's on, John.
There we are. Good to see you back in the seat, buddy. Welcome back. Jordan Rochester there of Mizuho. Coming up next on this programme, Jared Woodard of Bank of America, Adam Posen of the Peterson Institute, Jonathan Gold of the National Retail Federation, and Nela Richardson of ADP, the second hour of Bloomberg Surveillance. Up next.
The economy is pretty resilient. I think we still have some turbulence ahead.
We wouldn't say inflation risk is off the table completely, but it's certainly much lower risk than it had been.
If we were to see a much steeper slowdown than what we're anticipating, you certainly could get a steeper rate of cuts.
We don't really need that kind of stimulation, but it looks like we're going to get it anyway.
The fact that they are cutting is supportive of the risk sentiment, which is what we're leaning into.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with your equity market on the S&P 500 pulling back by 0.2%. The scores look like this. On the Nasdaq, just a little bit softer as well. Likewise on the Russell. On the Nasdaq 100, we're down 0.25%. On the Russell, the small caps down by 0.6. The week ahead, the next 24 hours for the labour market, it's going to be quite pivotal potentially because nothing definitive so far this week. Tuesday, the data was somewhat soft. Wednesday, okay, looking at the ADP. Later on this morning, jobless claims at 8:30 Eastern Time, which has been in and around 220 now for the last few weeks.
We've been asking repeatedly this week, what is more disruptive to this market, an upside surprise or a downside surprise? Matt Miskin of John Hancock earlier this morning talking about how the Citigroup U.S. Economic Surprise Index has turned positive. It is actually the most positive right now, going back to April. It raises this question, could this be the source of angst in markets that maybe if the Fed starts getting maybe pushed to be a bit more hawkish or less dovish, does that disrupt some of the euphoria that we've been feeling over the past few weeks?
I think we're more inclined to call these guesstimates and not estimates when it comes to payrolls. It gets much, much harder to guess them in the next month or so. We've got the strike at Boeing. We've got strikes at the ports across the eastern Gulf Coast in this country. You've also got the election anxiety, which some economists believe is leading to some companies to hold back on hiring as well. So take a guess for the month of October. That early November report that we get, I think, on November 1, tremendously difficult to forecast.
Not only that, also the effects of the hurricanes. People don't have access to clean water. People don't have power. They're not going to work. And so what I think when you hear from everyone on Friday, whether or not it's a good or bad report, they're going to say, well, this one doesn't really matter because the next one is the one that matters a lot. And it might be so noisy and difficult. But how does the Fed communicate to that, to Jordan's point, when they're going to be in a blackout period?
Neil Dutcher has made this point a few times over at Renmac. Ultimately, we're in the risk management business. If you no longer believe inflation is a big problem, if you're in the risk management business, cut interest rates. Just cut interest rates.
The problem is, and we keep talking about this, we've been talking about this from before Jackson Hole, after Jackson Hole, there's no clarity. We don't know what the destination is. We don't know what the neutral rate is. We don't know how far we are from it. We know Austin Goolsbee thinks that we're way, 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 way far away from it. And other people are saying, hold on, not so fast. You were speaking yesterday with Mark Rowan of Apollo, who said this is a very expensive rate cut. This is a very expensive insurance policy. So you start to put this all together, and is there the same sort of uncertainty on the Fed board that there is among market participants who are completely on opposite sides when it comes to this issue?
Mark Rowan, financing is available. Real estate prices are going up. It's not clear. We need more rate cuts. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day. Adam Posen's joining us in just a moment, in about 15 minutes' time. He's still got a call for rate hikes in 2025.
I want to understand from his point of view whether he's seeing anything on the ground now that indicates that inflation is starting to rear up again. Because we did see in the internals of, say, the ADP report, there still is disinflation when it comes to wages. We see some of the other CPI reports from around the world. Disinflation is much more prevalent. Or is this just an expectation of policy and how much it could shift things and just how vulnerable this economy is to a reigniting of that inflationary push based on the lack of softness that he's seeing currently in the market?
Fueled by another rally in crude potentially, 3 days and up by close to 5%. The Middle East really igniting things over the last few days.
Absolutely. And now there's talk of potentially what Israel's going to hit. The President Biden has come out and he said he wants him to stay away from nuclear. But now everyone's talking about maybe it's going to be energy facilities. And then what kind of tit for tat would the Iranians then place on potentially U.S. allies in the region and their energy facilities? So even though we do have spare capacity, there's lots of supply in the market and demand in China is still very low, the fact of the matter is the market's starting to wake up that this conflict can get worse.
Brent crude 75.32. Coming up this hour, we'll catch up with Jared Woodard of Bank of America Securities on when to get bearish on bonds. Adam Posen of the Peterson Institute expecting the Fed to return to hiking next year. And Jonathan Gold of the National Retail Federation as he calls on Biden to end the port strike. We begin this hour with futures slipping as investors await U.S. jobless claims and tomorrow's payrolls report. Jared Woodard of Bank of America Securities writing, big upside for the classic deflationary trades of U.S. tech and treasuries requires big bearish economic data. Otherwise, the risk-reward for deflation trades is poor. Better to think about when to turn bearish on bonds for 2025. Jared joined us now. So, Jared, let's get straight into that trade. What you would substitute bonds for, and why you believe maybe some of the moves we're seeing in the commodity markets might be the beginning of something much bigger.
Yeah, thanks for having me. It's good to see you all. I think the big structural view from Bank of America Research Investment Committee is that the 2% world of the past 2 decades is likely giving way to the 5% world that was the norm for the 20th century. 5% was the average inflation rate across the G7 countries in the 20th century. And I think that level of normal that has been so unfamiliar for many of us for the past, couple decades is actually where we're headed over the next several cycles, maybe even sooner. The view from an asset allocation perspective is that bonds are going to be much less effective as a hedge for your equities. They're going to give you much lower real return. And you're going to be better off with higher equity exposure, higher commodity exposure, higher credit exposure, especially higher yielding parts of the credit market than has been the winning trade for the past 20 years.
Do the latest moves out of China just increase your confidence around this thesis?
They do. I mean, we do think that the stimulus from China, while obviously helpful to the equity market in the near term, is not a game changer for the economic challenges that the country faces. China's government bond yield hit a record low of, I think, 2.0% in September. And it may be that the policymakers want to divert attention away from that part of the market and try to send capital elsewhere. But I think the important thing to think about is how different the world is from the past 20 years when it comes to China, when it comes to trade relations, to globalization, to even tech disruption, which is so deflationary the past 20 years, now is much more of a neutral factor. The software, the internet, smartphones, all pretty easy to adopt, easy to scale. Things like artificial intelligence and quantum computing are so resource intensive that even the tech disruptors, the big deflationary forces, come with a lot of front-loaded costs that we think present some pretty good investment opportunities.
Just to be very clear, Jared, how much are you saying that bonds just don't have a lot of upside and potentially certain commodities, not necessarily even oil, but say lithium or gold or copper might be the real beneficiaries of just a new investment wave? I mean, in other words, how much is this saying that this is a new inflationary regime versus this is a different regime where bonds don't have the same characteristics as in the ZERP world?
Yeah, I think that the correlation between bonds and equities has been positive for most of U.S. economic history. If you look at that long-term data, you see that on average, they've moved together more often than they moved apart. To see really strong negative correlation between bonds and equities, you really just have to look at the last 20 years. And so, again, we think that structurally inflation is likely to be higher in the medium term, even in the near term, then those bonds are going to be much less helpful as diversifiers. Where do you go with your capital instead is always the next question. And we think there's good parts of the equity market where people can allocate away from big indexes. But within commodities, there's great places to be as well. Gold, uranium, and tactically, like in present moments, oil.
Jared, I do wonder what this means for people who are putting money in money markets. There have been a lot of investors who come on this show and say it is time to lock in these yields. It is time to get out of cash. Those people with $6.4 trillion of cash in money markets are losing out, fear of missing out. How much are you saying that's not true? And actually, they stand to benefit quite considerably because this is sort of the new normal. Cash is actually an allocation.
That's exactly right. I think that the optionality of cash for allocating, into trades as they come along is much higher now than it's been in a long time as well. When you can get paid a meaningful yield, even possibly, a positive real yield on your cash, and preserve the ability to take advantage of opportunities in the market when they come along, that's a great place to be in as an investor. And it's not something that's been available to investors for decades. Data shows, by the way, that when the Fed starts cutting, even if you have investors with really high cash levels, historically, they haven't been prone to allocate away from those cash and cash equivalents until 9 or 12 months after cutting cycles begin. That's one reason why we don't expect some tidal wave of cash to come into the equity market, in the absence of some other economic catalyst.
Jared, you said present moment you'd be bullish on oil. Is there a ceiling for how high these prices can go?
Our commodity team has done a lot of great work on mapping out scenarios if, unfortunately, you had, further disruption, turmoil in the Middle East. They'll cite $100 a barrel and even higher, I think. The thought for us is that on a tactical basis, and we do have ETFs that cover these, and we think it's an interesting moment from a tactical trade opportunity because positioning is so short. I think the CFTC futures data shows you that on some measures, you've never seen such extreme, short positioning in oil. And if you think there is the risk of further escalation in a way that could be disruptive, or on a medium term, if you think there's a chance of a resurgence in inflation possibly next year, this looks like it might be an interesting entry point.
Just short of 72 on WTI this morning. Jared, we've got to leave it there. It's good to catch up, sir. As always, Jared Woodard there of Bank of America Securities on the commodity market and what you should be doing with your bond positioning. Just a note, just a programming note, just quickly. Bill Dudley, former New York Fed president, new column out on Bloomberg Opinion. I've been too pessimistic about the risks of a so-called hard landing for the US economy over the past few years. We'll be catching up with Bill a little bit later this morning at 8:45 Eastern time, so look out for that. Let's take a minute to get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Israel launched a strike in Beirut overnight after 8 of its soldiers were killed in southern Lebanon in battles against Hezbollah. According to local officials, 6 people died in the Israeli strike on a building affiliated with Hezbollah in the center of the Lebanese capital. The Israeli government has not yet retaliated for Iran's barrage of missiles on Tuesday night. Meanwhile, New York Mayor Eric Adams may be charged with additional counts in his corruption case. Prosecutors said it is quite likely that other defendants will be named in relation to the additional charges. Adams' lawyer has urged the federal judge to dismiss the case, calling it, quote, flawed, as the mayor deals with growing pressure to resign. And Costco has expanded its lineup of precious metals. The wholesaler has launched the sale of platinum coins and 1-ounce platinum bars on its website for the price of $1,089.99. The deal is only available to buyers with a Costco membership, of course. If you want one, you'll have to move fast. Costco's platinum offerings sell out almost immediately. That's your Bloomberg Brief. John?
Yahara, thank you. Isn't that incredible?
Well, I just love it because it's really catering to all the doomsdayers. They can stock up guns, gold bars, and MRSA packages to just make sure that they're okay.
It's working. Gold year today up by more than 28%. It's a trade that's working out.
You think about how people say always in China that's what they're putting their money into because they don't know where else to go. I wonder how much that's true in the U.S. as well.
It's truer. Can we say that? Does that make sense?
Yeah,
See
maybe.
More of it. Let's put it
exactly.
that way. Up next on the program, the risk of reinflation.
That's really the biggest concern right now is, are we going to overstimulate? Because in the no landing camp, we're arguing we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
The latest on this conversation up next with Adam Posen of the Peterson Institute, who thinks you should be preparing for rate hikes in 2025 and not rate cuts. That conversation up next. Just a bit of economic data to work through this morning. It starts with jobless claims at 8:30, then ISM services later after that, then tomorrow morning, the payrolls report, the estimate 150K, the previous number about 142. Into that, equities negative by 0.25% on the S&P 500. Bond yields a bit higher by 2 or 3 basis points, 380.75 on a 10-year. Under surveillance this morning, the risk of reinflation.
I am in the sticky inflation camp that the long-run inflation rate is probably closer to a 3 handle, if not a 3 handle, then down at 2.0%, where the Fed thinks it's going to be. That's really the biggest concern right now is, are we going to overstimulate? Because in the no landing camp, we're arguing we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
So here's the latest. Fresh economic data and Fed speak very much on deck. Schmidt, Kashgari and Bostic speaking this morning after jobless claims at 8:30. Adam Posen of the Peterson Institute with this to say. I stand by my call that the Fed will stop cutting rates by March of 25 and will be hiking by June of 25, seeing a 40% chance if Harris is elected, 85% plus if Trump is elected. Adam joins us now. Adam, welcome back to the program, sir. We've got a lot to work through here. Let's just start at the top. Why is the outlook for you in 2025 so election dependent?
Thanks for having me back, John. I think it's election dependent in 2 reasons. The first is whether it's Harris or Trump, I think the commentariat and a lot of the market people are overestimating the likelihood that a divided Congress will prevent fiscal expansion. You will get some fiscal expansion if it's Harris, and you will get outrageous fiscal expansion if it's Trump. And Annmarie and I have talked about this on a previous appearance. I think Congress is not going to block it either way. The second reason is specifically to do with Trump. In a recent analysis the Peterson Institute put out last week, we go through very carefully what his plans for general across-the-board tariffs, particularly migration, deportation policy, and interference with Fed independence would mean. And that puts you at an inflation rate of well above 4% easily.
And you've made the argument also that you think the Fed should be preparing for two-way risk and should be preparing market participants and the general public for two-way risk as well. That reminded me, like it reminded you, of the situation that Governor Carney was in back in 2016. Right. Why do you believe that's the right idea?
I think, John, thanks for having me back to talk about this. And you're right about the parallel with the Bank of England facing the Brexit call, something very political where they don't want to come down politically, but it's disingenuous to just sit there and say, well, what'll happen is what'll happen. I mean, in the end, that is what will happen. The Fed doesn't affect the politics or the outcomes. But if you're choosing to just every meeting just tack back and forth and update people's expectations, you leave a lot of room for volatility, and arguably you're going to cause more harm to the economy. Sometimes you have to be honest and just say, look, we are not going to pretend we the Fed have a view on Trump versus Harris, but we think there's a high risk of fiscal expansion and a high risk of additional tariffs and a high risk of disruption to labor markets either way. And all of that is inflationary or stagflationary. So therefore, we should not be encouraging the idea that there's either a further path of rate cuts in 2025 or encouraging the idea that all the risks are to the downside. This is different than the clip you just showed of Bianco. My concerns are about the policy changes and also, as I've written about and we've talked about, that the Fed is not as tight now as they think they are. It's not about that there's this persistent inflation, no landing. It's that new shocks are coming and policy is not as tight as they think.
There are two things here, Adam. One is they're not as tight as they think they are, a question around neutral, which is something that a lot of people in markets debate. Another thing is how much the Fed should try to get ahead of possible policy changes that could expand the deficit. How much would the Fed be exposing itself to incredible political risk if it weighed in? I mean, if it didn't ping pong around what the data is actually showing right now and tried to make a statement on whose programs would potentially be more inflationary at a time where the arguments on both sides contradict some of what you've been talking about.
Well, the arguments claimed, Lisa, may contradict, but the facts don't. And the Fed's job is to follow the facts and the basic economics. I think it is a risk either way. And obviously, Chair Powell and the leadership of the Fed has decided the way they're going to manage the risk is they're only going to talk about the next 3 months. And they're just going to focus on that. And that was very clear from the chair's speech at Jackson Hole. And so my push has been, at a minimum, admit that that's all you're doing and don't let people get notions about 2025 and beyond. But the second point is we're seeing a major erosion of politics and norms and stability in the US. And if you look around the world where there are countries where you have that, generally the central bank ends up having to be more outspoken, more principled, and more courageous. This is like in South Africa. This is like in India. This is like it used to be in Italy before the euro, that the central bank has to stand up. And the Fed's situation isn't quite as delicate, Lisa, as I think they think it is. And you just said it could be portrayed, because both Harris and Trump are going to lead to expansions of fiscal policy. Both Harris and Trump are not going to roll back tariffs and are going to increase them somewhat. The Fed doesn't have to say what we in a nonpartisan place can say. They don't have to say Trump is worse than Harris. They can just say the risks to inflationary policy are higher from both.
Adam, what would you say about the fact that even though people keep talking about the deficit, the bond market hasn't woken up to it? And a lot of people think it's never going to, simply because it hasn't in the past.
It's a fair concern. I mean, I don't have anything great to say about that because this is the dynamic you get. The U.S. is the global reserve currency. China's a mess. Europe is a partial mess. The world is unsecure in geoeconomic terms. So in relative terms, people are going to keep investing in the U.S. You were saying a little bit ago on the program about the increased interest in gold and Costco selling platinum to go with its meal kits. You know, this is Bitcoin. All these things are signs of people trying to seek alternatives to the dollar when there's no good state level, no good alternative currency. And I think all these investments will ultimately end in tears. But the fact is that temporarily gives the U.S. more room to run its fiscal policy, run its deficits. And that's part of why my forecast is that the deficits are only going to increase. It's not because I think that's good. It's not because I think it does no harm, but it is likely for the next few years.
Given all that you think about the direction of the Fed and what they're doing now, yesterday Mark Rowan told Jonathan of Apollo that this was the most expensive insurance cut that we've seen from the Fed in history. Would you agree with him?
I guess so. I wouldn't put as negative a spin on it, I guess, Annmarie, as that sounds, because insurance cuts have been rare in history. And I think insurance is good. You just have to be prepared once you've paid the insurance premium to write it off as a sunk cost. And that's all I've been saying. I mean, I'm on the record saying the Fed should have been cutting, maybe not 50, but should have been cutting this fall, because given where the short-term inflation outlook is, which is down, and the risks of a potential recession, it's fine for them to take out insurance. So I view that as good. But again, insurance is a sunk cost. My only point is warn people, just because you're taking out insurance doesn't mean that you're going to keep going in that direction. In fact, just because you're taking out insurance, you may make it less likely that you're going to keep cutting.
Adam, ahead of the election, I know you also have some thoughts on inflation, how it's central to voters, given the fact that we've had low inflation before this latest bout for 40 years. Who's messaging that the best? Are voters basically blaming Kamala Harris because of Bidenomics and they put the blame on Biden? Or is she doing a good job in explaining that tariffs may be inflationary?
I think it's more the latter than the former, Annmarie. Thank you for engaging with that. I mean, I'm not a pollster, but I can see that basic fact that inflation has become a dominant topic going into this election. All the polling data makes that very clear. People do feel as we look through the data as best we can, they're noticed price level shifts, right? So eggs went up a lot in prices. It's not that they're continuing to rise. In fact, some of it is they're falling, but people still feel the relative price shift they've already seen. And we know that they always feel, even if wages are going up, that's stuff they deserve. And if prices go up, that's stuff that's unfair. So they don't see the balance very clearly. I mean, they're allowed to see whatever they want, but that's how people see it. In this context, I think the Harris campaign is doing a good job building on some things that the Biden administration finally said in the last 6 months or a year, which is that tariffs are a tax, and there are particularly a tax on working people because the stuff people buy, their food, their toys, their clothes, their inexpensive furniture, their electronics, are infinitely cheaper because we allow imports and we allow competition and we allow choice. And so I think that message from Harris campaign that they would not put on a general across the board tariff the way the Trump people and the former President Trump keep saying he will, is getting home. There's still a legacy that, you know, when you're president, you get the blame, just like the Fed, whatever happens on your watch. So there's still a legacy of Biden that inflation occurred on his watch. And whether or not it was his fault, that doesn't matter. That's still a drag.
Adam Posen. Adam, appreciate your presence this morning. You've been out front on this issue, the risks around 2025, and we'll keep this conversation going into year end and beyond. Adam Posen there of the Peterson Institute. Up next on this program, Jonathan Gold of the National Retail Federation and Nela Richardson of the ADP Research Institute weighing the impacts of the ongoing port strikes. Their conversation up next. As things stand, we're heading towards the first weekly loss in about a month on the S&P 500, but still a lot to play for. Thursday, Friday, and a ton of economic data. Equity futures are down by 0.2% on the S&P. On the Nasdaq 100, we're down by a third. Just a little bit lighter, heavier, negative on the Russell, Lisa. We're down by 0.5% on the Russell.
It's after a massive rally, and how much is this just simply people who are hedging their bets for Octobers that tend to be messy and are complicated by a whole host of other factors right now versus true concern about some sort of weakening in the labor market, or is it that the Fed's not going to cut rates as aggressively? Take your pick. There are both sides of the discussion that are still at play and on opposite sides.
Fantastic conversation with Adam Posen of the Peterson Institute just moments ago, raising the risks of 2025 and making the argument that the Federal Reserve needs to communicate to market participants and the general public now about the risks associated with the prospect of increasing interest rates again next year. 2
points here. One is that the baseline neutral rate is actually substantially higher than people expect, including the Fed, that there is more underlying inflationary pressure and growth. And the other side is that a lot of the policies that are being proposed all will be inflationary and deficit increasing. So in order to get ahead of that, the Federal Reserve should be at least telegraphing that they're sensitive to that particular risk. They're not going to do that. The first side, I think a lot of people are debating, but it continues to be a debate in markets.
We talked about this with Adam. It reminds us of the situation that Governor Carney found himself in back at the Bank of England in 2016. And his central argument when he spoke out was the right one. It would leave the economy more prone to bouts of inflation. It has done. But it wasn't without costs. It attracted the wrong kind of attention to the institution. We can talk about whether it led to reputational damage. That's the kind of conversation that this Federal Reserve is very, very nervous about having.
Problem is right now we haven't seen it play out in the bond market. We haven't seen longer-term yields rise in ahead of some sort of increase in the deficit or ahead of some sort of policy shift. And without a bond market freakout, you can't have the central bank step in and say they need to respond to it. It's almost saying, look, the bond market needs to do it first before sort of give the Fed cover. And that, I think, is sort of in the popular mindset.
Well, there's no freak out right now. Bond yields are higher by just 2 basis points on a 10-year. Let's call it 380. At the front end of the curve, up a single basis point. In and around 365. Very, very range-bound through the week so far, with lots of economic data behind us and still tons of economic data in front of us. We mentioned the Bank of England. It's now Governor Bailey running that institution, and this is what he said about pound sterling a little bit earlier on today. The prospect of getting more aggressive on rate cuts. Speaking to the Guardian newspaper, the pound down by more than 1 full percentage point, 131.
And honestly, he's joining with everybody else, finally realizing if inflation's coming down, why not cut rates? You're facing off with the potential deterioration. Although, interestingly, after the United Kingdom was left for dead after Brexit, suddenly it's showing a bit more strength than even the Euro region. And we're actually seeing some more positive outlooks coming from the Bank of England. So just sort of an interesting backdrop as they look to try to keep that going rather than torpedo it with higher rates.
Potentially the biggest one-day loss going back to March of 2023. For sterling against the US dollar. Under surveillance this morning, President Biden saying Israel must hold off from attacking Iran's nuclear facilities in retaliation over this week's missile barrage. Biden also saying G7 nations agree Israel has a, quote, right to respond, but they must respond proportionally. Israel carried out more strikes in Beirut overnight. What does that P word actually mean in reality?
I think this means basically stay out of the nuclear facilities. President Biden made that very clear yesterday. You know, we were talking to Stephen Cook and I mentioned this article that Tony Blinken, the Secretary of State, talked about how the strategy from the Biden administration has put the U.S. in a much stronger geopolitical position. Well, his deputy, Kurt Campbell, was talking yesterday and he had this to say. The region is really balancing on a knife's edge, and there are real concerns about an even broader escalation or continuing one, which would imperil not only Israel, but our strategic interests as well. When he says strategic interests, you've got to think it's the energy market, especially ahead of an election.
You just have to wonder how much Israel's going to go it alone at the same time that they haven't really been taking a lot of cues from the U.S. But broadening out, what does that mean given all of the players who do not want to get involved in this versus the ones who are sort of at the table here?
Peter Chair raised this at Academy Securities. We talked about this yesterday. Israel, over the last few weeks, has demonstrated superior defense, superior attack, superior intelligence. And he raised the question, why would they stop? Why would they start where their enemies are ultimately on the back foot right now?
One thing that I don't have a clear sense of is how much more does Iran have? What potentially could be holding them back with respect to some red lines for the U.S.? They could potentially withdraw support. But basically, Iran still has a lot of missiles. Iran still has a lot of firepower. And ultimately, do you want to have a peaceful situation or do you want to have a full-on war where there's a lot of damage and a lot of death?
Speaking of red lines, red headline on the Bloomberg, Libya, the oil minister says oil outputs resume on Thursday. Good timing, given what we've seen on this screen in the last few days.
But this just adds to this fact that this is why oil, even though we are seeing such an escalation in the Middle East, there's still a ceiling on it. Because why? There are cheaters. There was a Wall Street Journal report about that, with Prince Abdulaziz really wanting to hunker down on some of these individuals who are fudging their production output. And now Libya is saying, well, we got our act together. We're going to add more barrels to the market. So if you're concerned about prices going higher, potentially you can wait, because there's also the demand story in China.
Crude just off session highs off the back of that. I wanted to squeeze in this story. OpenAI has completed a deal to raise $6.6 billion in new funding, giving the AI company a valuation of $157 billion US. Thrive Capital and Microsoft leading the round. The deal is one of the largest ever private investments and makes OpenAI one of the 3 largest venture-backed startups. Just phenomenal numbers.
Yeah, you start talking about what the other startups are. It's something like TikTok and the likes that you've seen with similar types of valuations. You just wonder, again, how much do we understand the application of, say, ChatGPT and the future iteration of this? There was one investor, Mashiosa-san, who came out and basically started saying that it will cook your dinner, it will order your groceries, it will clean your home, and it will organize your children's homework. So if the AI can do this, I'm all in.
Given what Apollo said just yesterday, maybe this company stays private and never goes public.
Because it's not a matter of private equity, but rather equity that stays private.
Let's turn to this story. The East Coast port strike continuing into its 3rd day. No negotiations between the ILA union and its employers are planned. Port owners under pressure from the White House signaling late yesterday they're open to new talks. Major trade organizations, including the National Retail Federation, calling on the White House to intervene in the port strike, writing in a letter, quote, "This has now become an issue of both economic and national security. The strike will cost the economy billions of dollars a day, impacting businesses large and small. The administration must now step in to not only get the ports open again, but work with the parties to resolve the outstanding contract issues." Joining us now is Jonathan Gold, VP of Supply Chain and Custom Policy at the National Retail Federation. Jonathan, welcome to the programme. Who do you blame for this? Are you going after the unions or the administration, the White House?
Look, at this point, the parties have been negotiating or trying to negotiate for a better part of a year. And unfortunately, the ILA walked away from the table in June. We need both parties back at the table to continue negotiations. At this point, now that we're in day 3 of the strike, the administration needs to use all of its authorities to get the ports open and get the parties back to the table and get a contract done.
Can you walk us through where retailers are currently at with regards to inventories and what the situation looks like at the moment compared to what it looked like the last time we had a real supply side shock a number of years ago?
So many retailers were preparing for this situation. You know, they were keeping an eye on the labor negotiations. Many brought product in earlier in the peak shipping season. Many shifted product to the West Coast ports. But even with some of that preparation, there's concern that the longer that a strike goes, the more of an impact it's going to have.
Jonathan, I'm seeing local reports in New Jersey that consumers are actually starting to hoard some items like toilet paper. Is it warranted?
Not at this point in time. Look, again, retailers are always planning for supply chain disruptions. They've got product on hand. At this point, you know, we're not going to see impacts to the consumers for several weeks if the strike continues. Obviously, we need the strike to end, the ports to get open, and product to start flowing again. But at this point, we don't think there's a need for a consumer rush.
When you say the White House needs to get involved, are you saying the president should invoke Taft-Hartley?
He should use all of his authorities. If they need to use Taft-Hartley, then that's the process they need to use. We look back to what happened in 2002 when we had an 11-day lockout on the West Coast ports, and President Bush at that point invoked Taft-Hartley. So at this point, whatever authority the president can use to get the ports open and get the parties back to the table, they need to use.
But Jonathan, do you think given the election, this administration in no shape or form is going to do such an act?
At this point, you got to look at the election, but you've also got to look at the national economy. You know, J.P. Morgan saying $5 billion a day hits the U.S. economy. It's not just the port workers who aren't working, but the potential for other industries to be hit pretty significantly, as we've got inputs to production that are coming through these ports. You've got our farmers who are trying to get product to market. All these industries and companies are going to be impacted. So we've got to take a look at the betterment of the national economy to get these ports back open.
Jonathan Gold of the National Retail Federation. Jonathan, appreciate your time. We're going to continue this conversation around the table with Nela Richardson of the ADP Research Institute. Nela, good morning.
Hi, good morning.
I wanted to share these numbers with you from Anna Wong of Bloomberg Economics. If the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as many as 80,000 jobs. How do you read between the lines what's going on here and what it might mean for data in America?
I think the bigger effect of a prolonged strike is really in inflation. We talked about how maybe a policy change just a few minutes ago with Adam Posen, how a policy change could actually affect the current level of prices. Well, this strike would have an immediate effect on price changes. And that's going to play into an immediate response by the Federal Reserve that they will have to be active about. So in terms of the labor market, for us, it probably won't have an immediate effect at ADP because remember, we're counting the number of people on payroll. And so whether they're striking or not, if they're part of payroll, they're getting counted. For the BLS, it will have probably a more pronounced effect because they are counting the number of people who are getting paid. And if they're striking, they're not getting a paycheck. What does that mean for the economy? If you have a significant number of people who are not getting paid and the knock-on effects of other industries, other businesses affected by the strike, then you have something that is much more vulnerable for what has been a pretty resilient consumer. And so it is troubling. The more prolonged the strike, the more vulnerable the U.S. economy.
And it's basically everything that the Fed doesn't want. It's a stagflationary shock because you said it could potentially cause inflation to go up and potentially could reduce people's spending power. Where in particular could you see inflation really rise quickly as a result of these strikes if they go on for a while?
Well, that's fairly uncertain. It's hard to predict. But if you go back to what really triggered inflation in 2021, it was not just the fact that there were supply chain logjams and you couldn't get production. It was the fact that you couldn't get people to take stuff off the boat. You couldn't get those things from the dock into the store. If that returns, then we have an inflation picture that is not just based on services, which it has been for the better part of a year, but goods inflation now starts to rise. Goods inflation, which we thought we'd solved. And so that raises another specter in October, and we don't want that. No one wants that.
When does it start, though? Because a lot of people who talk to say there's a little bit of a gap they have. There's some leeway here. When does it really start to hurt?
Again, the timing is uncertain. I would think if this lasts 30 days or more, we're starting to get into some real price impact, but there's no way of knowing right now how long that would take. So I think that uncertainty alone has an economic impact. It's funny because we kind of reached a nirvana, at least when we looked at the ADP data in September. Everything kind of came together into this nice equilibrium, and it looks like it's going to last about 2 weeks. And something else is going to happen to topple us from this equilibrium, and that's why the Fed it really can't pause, it really can't go to sleep. It's very in the moment, it's very data dependent, and it can't think long term right now because there are all these other things, from oil prices to striking workers, that could tip the scales again and tip up inflation.
That's exactly where I wanted to go. Yesterday, we got the ADP report. Some people are saying that it's actually more accurate these days with respect to predicting what non-farm payrolls, which is not a goal, I know, of the ADP report. But how vulnerable were those figures to some sort of disruption, to the downside? In other words, do you think that the risks, like the Fed, are truly skewed to weakening to the downside when it comes to the labor market?
What we saw was a rebound in employment. We went from a revised 103,000 in August to 143,000. It was the first time that 9 out of the 10 super sectors that we follow all posted job gains. The only one that slumped was information services. So we were really cheered by this report, also because wages had stabilized. So we got all these job gains without a noticeable increase in pay growth. So I call this economic nirvana for the Fed. This is exactly what they wanted to see. More jobs being created, but not a big pickup in wages that could tip over into inflation. Now I don't know for October what's going to happen. And so I'm not sure that this economic nirvana in September can be sustained.
So you've got Andrew Hollenhorst on one side of the sphere saying basically you could see a real weakening that leads to recession. You have Adam Posen, you have many others, Jim Bianco, coming out and saying actually the risk is with a reacceleration of inflation and that there's a real concern that the Fed is being too aggressive in their rate cuts. Mm-hmm. Based on the data you look at, which is more accurate?
There's truth in the short and long term, and that's the hard thing for the markets to get around. I do believe that we are not going back to sleep on inflation for the next 2 decades, that periodic bouts of inflation is now part of our new normal. But At the same time, we've seen inflation come down a lot. We're not seeing wages pick up. We're still seeing healthy hiring. And when we talk to clients at ADP, both small and large, what we're hearing is what we heard over the summer was a bit of stasis. Like, I'm not sure. There's so much uncertainty. I don't know when the Fed's going to cut. I don't know how much. Maybe I should delay hiring. Well, what triggered in September, what it looked like is that, okay, the Fed started the rate cut. Maybe I can go forward with my talent management plans. Maybe I can hire those new workers. And we saw a little tick up in the JOLTS report for job openings. We saw a little strength in the hiring, and that was good news. Now we're getting another bout of uncertainty. So that might mean that the head of the turtle goes back in the shell for a little bit when it comes to hiring.
Nela, appreciate the update. As always, thank you. Nela Richardson of ADP. What Nela said at the end there, I think is really important. The anxiety around the election. It's been a real story over the last few months when it comes to hiring. Is that going to change once we get past that hump in November?
Will there just sort of be this incredible surge in hiring and, frankly, in economic activity, regardless of who wins, as long as there is some sort of conclusion as to who wins? Interesting, though, that the rate cut also unleashed the same type of activity.
Well, that's the key point. If there is a conclusion, and we naturally know the outcome of this election pretty quickly. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. The British pound is weakening against the dollar, with the currency poised for its worst day since 2022. This coming after Bank of England Governor Andrew Bailey suggesting the central bank could take a more aggressive approach to lowering interest rates. The governor's comments in an interview caused investors to bet on quicker reductions from the central bank, eroding the currency's appeal. Traders previously thought the BOE would be behind its peers on easing policy. Meanwhile, small donors are fueling the Trump campaign. It said it raised $160 million in September, with the majority of donations under $200. But the small donations were not enough to outpace spending. The Republican presidential nominee spent $12 million more than he raised during the month. This is the second month in a row that's happened. The campaign kicks off October with $283 million cash on hand. And two prominent Democratic senators have criticized U.S. Steel CEO David Burritt over his potential $72 million golden parachute if the sale to Japan's Nippon Steel goes through. Senators Elizabeth Warren and Sherrod Brown wrote to Burritt over their concerns, saying such payments, quote, demonstrate a repulsive conflict of interest in which U.S. Steel executives can enrich themselves at the expense of U.S. Steel workers. U.S. Steel has acknowledged receipt of the letter and says it plans to, quote, respond to correct its many inaccuracies. That's your Bloomberg Brief. John?
Thank you, Yahara. You want to talk about going after executive pay now? Is that what's happening?
Well, no, I know what you're going to say.
You're just going to go through every contract of the CEO on the S&P 500 and talk about how bad it is?
I feel like it's almost a badge of privilege for some people when they get an Elizabeth Warren tweet.
Is that what you think? I think they're like proud of that?
No, I don't know. I wonder if they're best. How quickly am I going to get this?
Okay, let's move on. Up next on the program, bracing for a supply shock.
We have had a move in crude, let's call it 5-6%, since Iran has retaliated against Israel. But we are still very much at the bottom end of the range here in crude.
3-day rally on crude, the latest from Citi. Up next. Oil up for a third day. Crude right now 71.12 on WTI. Off session highs. We're up by 1.5%. Under surveillance this morning, bracing for a supply shock.
We have had a move in crude, let's call it 5-6%, since Iran has retaliated against Israel. But we are still very much at the bottom end of the range here in crude. This is not a market that's panicking too much about what will happen if there is a supply disruption. And that's because they are focusing on the OPEC plus spare capacity.
So here's the latest. Oil rising for a third day as traders assess supply risk in the Middle East. Israel expected to retaliate against Iran following this week's missile barrage. Eric Lee of Citi saying these developments add another layer of uncertainty to the oil market, with the ultimate impact on global oil balances and prices hinging on the degree of Israel's response. Eric is with us here in New York. Eric, good morning.
Morning.
Let's think about this. If they begin to target energy infrastructure in Iran, how many barrels are actually at risk? Do you have to think beyond just Iran?
Yes, but actually Iran is really the starting point, right? Iran produces about 4 million barrels a day of crude oil and condensates. So any actual attack to its oil infrastructure, hitting production or exports, would be a big deal. It's just that we've seen a number of steps before we can get there. However, this time we're a little bit closer than we were back in April, when it seemed like both sides were trying to somewhat de-escalate.
Aside from just calling whether or not this is going to escalate to the degree of some real fundamental disruption, it's fascinating to me that you see the upside band of oil prices at about $75 a barrel, and you see the more likely trend downward, that you actually think that prices will eventually get back to $60 a barrel next year. Is this because of U.S. production? Is this because of more use of alternatives? How do you understand the lack of impact that full disruptions would be this time around, at least as represented in the market?
Yeah, it's a bit of all of the above, but one big part of it is that markets have been artificially tight because OPEC Plus is holding something like 6 million barrels a day of spare capacity from the market. And they have a plan to bring it back, even if they might keep pushing it back. With that plan in place, with so much oil potentially overhanging the market, I think it's capped, provide a bit of a soft ceiling to where prices can go and capped upside volatility.
Can we go back to the Israeli response? If they go after the energy facilities in Tehran, we heard from our reporter in the region, Jumana, talking about the fact that maybe they're going to go for the domestic consumption. But then wouldn't the Iranians just move the 1.7 they export into the domestic economy?
Here's where, looking at oil for over a decade, it's always like sometimes people will liken it to a large bathtub, right? You shift oil around here, it sloshes around, and other things get impacted. So yes, it would get moved around, but then that would still tighten up availability for oil, crude oil or refined products elsewhere, depending on what the size of that is. So all of it would be something that causes oil to spike up somewhat, which is not what everybody wants at this point.
Do you see an Iran that's willing to compromise some of the trade flows going through the Strait of Hormuz?
Sorry, can you repeat that?
Sure. Do you see an Iran that's willing to compromise some of the trade flows going through the Strait of Hormuz?
Yeah, to us, that's always been the very, very low probability, high impact risk. I think in many ways, most people not dismiss that, but push that right into the tail, right? This seems like it would be very much a last resort where Iran would be, would be somewhat of a self-inflicted blow as well, but to impact everybody else. So if this does escalate, if Iran's own domestic oil facilities get hit, this would be one way that they could strike back at really a lot of players all around the world, but hurting themselves also in the process.
Given the potential tail risks, you talked about a potential cap to the upside in prices as well as volatility. What is that cap, effectively, that could be a ceiling even in some of the tail case scenarios?
So if we're talking about, let's say if Israel does hit Iran's oil exports, it's about 1.5 million barrels a day. As I mentioned, OPEC Plus has a plan to bring back voluntary cuts of 2.2 million barrels a day over a year. They're poised to do so. There's a lot of talk as to whether they will start in December. But we do think that any sort of supply disruption, tighter conditions in the market are exactly the signal they need and the opportunity to bring back some of that oil that I think at least some of their members are quite eager to bring back to market.
Javier Blas, Bloomberg Opinion just yesterday, the oil price that matters now is 50, not 100. I'm sure you read that. He thinks there's a bigger risk of going back down to 50 than going to 100. Do you share that view?
Broadly speaking, yes. We've been calling for $60 oil next year really since earlier this year. That's this is assuming, actually, in our base case, we think OPEC Plus will keep pushing this down the road. They won't actually bring back in December. They'll keep pushing this back because market conditions are relatively soft. If they bring some back and non-OPEC Plus supply grows and demand disappoints, we could see a 5 handle. We could even see a 4 handle.
Wow. Eric Lee of Citi. Eric, appreciate it. Right now, we've got a 7, 71.29 on WTI. Lisa, Brent crude at about 75.
Just highlighting how different it is this time around from previous conflicts where people were calling pretty quickly for $100 a barrel in terms of crude.
Pretty big range.
Yeah.
Coming up on the programme, in the next hour of Bloomberg Surveillance, we'll catch up with Tracie McMillion of Wells Fargo, Tom Narayan of RBC, Lindsey Piegza of Stifel, and former New York Fed President Bill Dudley with a bit of a mea culpa on the hard landing call. That's all coming up next from New York. This is Bloomberg.
Fed's laser focused on the labor market.
There's some slowing, but it's not contraction. It's not deterioration of the labor market.
These are still numbers that are very constructive for the labor market right now.
Everything's on the table for this Fed. You could get to 25s if the jobs data are good.
The distribution of risks with respect to the labor market are clearly skewed to the downside still, even after this 50 basis point move.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell, 30 minutes away from jobless claims. Your estimate, 221. The previous number, 218. For tomorrow morning, for payrolls Friday, 8:30, 150, the estimate in our survey. The previous number, 142. That's the setup for the next 24 hours. Equities, the scores, going into that, pulling back just a touch. We're down 0.1% on the S&P. On the Nasdaq, we're down 0.2. On the Russell, we're down 1/3. Lots of economic data in the next 24 hours, including another ISM services read, with a big focus, I think, Lisa, on the employment component.
Given that we saw the manufacturing employment component really surprised to the downside, that said, I do wonder where the balance of risks is. What we have seen is better than expected economic data increasingly come out. Most upside surprises going back to April. You wonder, is the bigger risk right now for equities the idea the Fed's not going to cut as much, or the idea that you get some sort of more serious weakening? I can't tell. Based on everybody who talks to us, they all line up on the opposite sides.
Let's explore that word risk. Risk. It cuts both ways. Crude, third day of gains, up 2% on WTI, 71.50 on Brent crude right now, 75.50, up by 2 full percentage points. When I say it cuts both ways, I'm talking about supply risk. That cuts both ways.
Well, yeah, because we just have a redhead now that Libya is ready to also add more into the market. Keeping a lid on this, then you have to take into the fact that you also have a number of cheaters. But when you also talk about risk, it's not just the geopolitical risks in the Middle East, and we're waiting for Israel to respond. President Biden yesterday saying, hold off on nuclear facilities. Everyone is now talking about maybe energy facilities getting hit. But a trifecta of risks right now when it comes to what's going on in the United States, when it comes to hurricanes and the dock workers.
There's a question about how much we've seen a changing in some of the affiliations, some of the associations of asset classes and events, whether it comes to oil and this question of what kind of knee-jerk response there will be because of the structural shifts in that market, or with respect to bonds as a haven asset, given some of the concerns that Adam Posen raised about potential reignition of inflation.
Remember that quote from Chairman Powell a few Jackson holes ago? Navigating the stars under cloudy skies.
Yeah.
Getting cloudier. They're not clearing, they're getting cloudier.
And yet his iterations have only been, his utterances have only gotten clearer. So there's sort of this question, what gives, right? But you're correct. Right now, these skies are about as cloudy as I can imagine. The fact that all of these incredibly intelligent people who I have incredible respect for come on and say the opposite things from one another. And I'm like, yes. And then another person come out, yes. You know, neither could be correct. And that's sort of where we are.
Strikes, Boeing, across the ports, anxiety around the election, all holding people back from hiring people, you'd imagine. And you see that in the job openings. You see that in jobs data this week.
What was fascinating was what Nela Richardson just said, which was that a rate cut, a 50 basis point rate cut, gave a lot of employers the willingness to go out and restart some of their hiring plans. Whether that fades now really quickly with the fact that you've got dock workers on strike and the hurricanes and some of the uncertainty around the election is the reason why she's saying we have no clue.
The opening bell just around the corner. Equities, your scores. Equities recovering just a little bit. We're down only 0.1% on the S&P 500. We've talked about crude. Here's a picture of the bond market for you. Up 2 basis points on a 10-year, 380.56. Coming up this hour, we'll catch up with Tracie McMillion of Wells Fargo, with equities on track for their first weekly loss in a month. Tom Narayan of RBC, as Tesla's first quarterly sales gain this year still disappoints investors. And Lindsey Piegza of Stifel on the Fed's mixed messaging. We begin this hour with stocks on hold ahead of jobless claims in just under 30 minutes' time. The appetizer for the Fed's next big data point, September payrolls. Tracie McMillion of Wells Fargo saying September payroll growth is expected to tick higher. Likely no big surprises that will change the Fed's attempt to lower rates at a slow pace. We expect another 50 basis points of cuts this year and another 75 basis points of cuts in 25. Bottom line, now is not a time to rush to sell equities. Tracie joins us now for more. Tracie, welcome back to the show. Where do you want to be in this equity market?
Yeah, so we see choppy markets from here at least through the election. So what we're telling our investors is that look through some of the current risks and look out to our 2025 forecasts where we do see upside potential for equities. So any pullbacks here related to these ongoing and emerging risks would be opportunities to position into equity markets. So potentially selling some short-term fixed income, some long-term fixed income, and reinvesting those proceeds in equities as we do see some potential for pullbacks here.
You've touched on how you'd fund that position. Let's get into equities just a little bit more. Last time we spoke, I think it was large over small, DM over EM. Is that still the case, or has China changed that story?
China has not changed that story, although we do think that the potential there is somewhat interesting. But we believe that the longer term, more secular challenges that China is facing with their property market, with very high unemployment for their youth population declines, those things we think are going to be difficult to surmount. So we do continue to like developed markets over emerging markets. And we like U.S. over international.
At a certain point, when you talk about the U.S., you wonder how much you're betting on the Fed cutting rates aggressively, or you're betting on a more resilient economy that leaves the Fed cutting rates less aggressively. Which is better for your sort of more risk-on tone to come to fruition in 2025?
Yes, Lisa, we actually think it's the latter there, that the Fed won't have to cut as many times as the market is expecting because of a reacceleration in growth. So what we envision is that growth will start to slow some here towards the end of this year and into 2025. And then as monetary policy cuts start to take hold, we'll see a reacceleration into the latter part of 2025.
I have to wonder about what's going on right now with the equity market taking a breather, led down by the Russell 2000. This comes in tandem with a slight tick up in two-year yields. Basically, people in the bond market wondering if maybe they got over their skis, looking at some of the upside surprises to economic data. I just wonder if the rotation out of large cap into small cap, into the equal weight can continue if you get a less aggressive Fed.
Yeah, so we do think that is possible, particularly the rotation into small caps. So we are starting to build a position in small caps. We had been underweight small caps, significantly underweight for about 2 years. We're starting to build that position again because we do think that lower rates is going to imply a better credit availability, and just the reaccelerating growth will be a better environment for small caps going forward. We also think that that's going to foster a broadening of opportunities into quality sectors and cyclical sectors like industrials and materials and energy, communication services and financials. We think all of those sectors should start to benefit with that broadening.
Tracie, can you just pick up on the small caps point just a little bit? How are you recommending people play that? Is that through the index, through the Russell 2000, specific sectors like the ones you mentioned? How do you do it?
Yeah, so the Russell 2000 is a difficult index to invest in as a whole because the number of non-earners is rising in that index and approaching nearly half of that index. So we would be more selective going with fund managers who can pick and choose within the small cap universe, because not all of those companies are companies that we believe are viable.
You mentioned the financials. In 2 Fridays, we'll get some earnings from JP Morgan and a bunch of other banks as well. I want to go back just a number of weeks because that was a dominant story a few weeks ago, before the strikes, before the issues we see in the Middle East. It was what we heard from Ally Financial about maybe some credit issues. At the same time, we heard from JP Morgan about managing interest rate risk and what that might mean for the bottom line. Tracie, what do you think is going to stand out this earnings season?
Yeah, so we think that financials should continue to benefit from the front end of the yield curve moving down. We also think that as yields rise, we're seeing the 10-year starting to rise, we're seeing the 30-year starting to rise. That gives banks some ability to improve their net interest margins. So we believe that that is a good driver for the next 12 months for financials. This earnings season, the expectations have been ratcheted down. Analysts are moving their estimates down. We think that that's going to add to the choppiness for this quarter. And again, we look for any choppiness, any pullbacks, particularly if we get to 5,400 or below that. That represents a really good buying opportunity, we think, for U.S. large caps.
Tracie, how much are you just waiting for the election to be over and then you're going in and buying equities?
So we're not necessarily waiting, because typically we see the volatility ahead of the election, and then we tend to see equities rise following the election. So after that uncertainty is out of the market, that's when we see buyers coming back into the market. So again, looking for that volatility this month potentially to reposition into small caps, into large caps, and into our favored sectors.
Tracie, thank you. Appreciate the update from you and the team over at Wells Fargo. Tracie McMillion there on the equity market. How many people feel that way? Hey?
Oh, I'm sure. I mean, we talk about with companies, but how many other investors are basically getting call options and figuring out where they should, enter to protect against volatility, and then saying, it always rises afterwards.
We mentioned Scott Rubner of Goldman Sachs. There's the super tactical stuff over at Goldman on the equity side of things. I shared this quote earlier. It's worth repeating. I'm bullish on US equities for a year-end rally starting month-end, and I'm worried that my 6K target is too low.
Savita Subramanian came out with a note where she basically said, what's seasonality? Usually this was a rough season, and it has been anything but. The sort of steady climb, the grinding climb sort of belies this feeling of volatility that we see with headlines and narratives.
Just a little bit softer right now on the Russell, on the Nasdaq, on the S&P 500 as well. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. The catastrophe modeling firm KCC is estimating the destruction from Hurricane Helene will cost insurers $6.4 billion. Meanwhile, AccuWeather estimating the total economic damage could hit $160 billion. That would make it one of the 5 costliest storms in U.S. history. President Joe Biden and Vice President Kamala Harris are touring parts of the Southeast and announcing steps to bolster recovery efforts, with the death toll rising to 166 across 6 states. New York Mayor Eric Adams may be charged with additional counts in his corruption case. Prosecutors said it is, quote, quite likely that other defendants will be named in relation to the additional charges. Adams' lawyer has urged the federal judge to dismiss the case, calling it flawed. This coming as the mayor deals with growing pressure to resign. And Amazon plans to hire 250,000 people in the U.S. for the holiday shopping rush. The amount is unchanged from last year, an indication the company expects steady demand in its biggest market. In a move to entice recruits, the online retailer recently said it was raising hourly pay by at least $1.50 for 800,000 of its transportation and warehousing workers in the U.S. That would bring pay to more than $22 an hour for those workers. That's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with you again in about 30 minutes' time. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Tom Narayan of RBC as Tesla's first quarterly sales gain this year disappoints some investors, and we'll get his views on what is going on with some of the big automakers elsewhere after some big cuts to the outlook from the European players. That conversation up next. 1 hour and about 15 minutes away from the opening bell. Equity futures pulling back just a touch. We're down 0.1% on the S&P 500. Let's get you some morning calls. First up, Deutsche Bank lowering its price target on Boeing to 195, citing negative impacts due to the ongoing machinist strike. The stock is down by only 0.06% in the pre-market. Your second call from Barclays, downgrading Stellantis to equal weight, pointing to inventory issues and eroding market share. That stock is down another 3.5%. And finally, Truist, raising its price target on Tesla to 236, seeing higher selling prices offsetting lower deliveries. Stocks nil down. That name is lower by 1.55% in early trading. Sticking with Tesla, Tom Narayan of RBC keeping its outperform rating and writing this. The For Tesla shares to be trading lower on an inline delivery print for Q3, in our opinion, makes little sense. This is not an auto business. Most of our valuation for Tesla is in autonomy. Whether it beats consensus estimates by a few thousand vehicles or not says little about the true value of this company. To talk about this industry, Tom joins us now for more. Tom, I think we need to take a giant step back before we get knee-deep in Tesla. It's been a phenomenal few weeks for this industry. We've had cuts to the outlook from Stellantis. We've had 2 in 3 months from VW. Pain elsewhere as well. How long before we see the same from Ford and GM?
Yeah, that's the question that everybody wants answered. I think it's a tale of two stocks between GM and Ford. Ford, interestingly, if you look at the dealer inventory levels, which is really what caused Stellantis to cut their guidance so substantially, Ford's dealer inventory levels are now above that of Stellantis. That's the bogey. That's the one we're the most worried about that could profit warn next. The consensus is around $10.5 billion of EBIT for 2024, and the guidance is for $10 to $12 billion. It could suggest that that could be the next domino, but we would highlight a lot of the pain in Europe is isolated to Europe. Ford's Europe exposure isn't as substantial, and also China not as substantial, but we do think Ford could be next.
Tom, how much excess capacity do you think is in the auto industry right now?
Yeah, that's definitely an issue, especially on the EV side, right? That's why they're trying to cut back. Pricing is really at all-time highs, so they're trying to find excuses to cut production to lower to keep pricing higher. But as we all know, there's only so much production cuts you can do. Eventually, people have to buy the cars. And so, they could try to cut production, but we do think discounting will eventually have to happen. And that's another reason why we think all these, especially the European companies, are cutting their guidance.
Tom, how different is the European situation for automakers versus the U.S.? You said that it was sort of a different situation. Can you elaborate on just how much it is?
Yeah, that is definitely true. If you look at how the European automakers cut their guidance, BMW cited a supplier issue, which was Conti. Mercedes cited China, the top end. VW, it was the European consumer. Stellantis, it was really the U.S. That was the one that maybe makes folks a little worried for Ford and GM. But it's really China and Europe that led the European cutbacks. There's also an old thesis of never let a good crisis go to waste. If everybody else is cutting, why don't you go ahead and reset expectations? In the U.S., maybe they're not thinking that way. But we still think that there's a good likelihood, if there's a price war in the U.S., that you could see it trickle down and impact the U.S. as well.
Tom, hold on a second. You said never let a good crisis go to waste. And I want to build on that, this idea that not only could you cut your price targets and your sales forecasts, but you could also cut staff at a highly politically charged time when that's very difficult to do, particularly in Europe. How much do you start to expect some of the cuts that we've already seen announced to only escalate, not only in Europe, but also in the U.S.?
Yeah, that whole debate is really raging, as you guys well know, in Germany and in Europe. We think that's probably more of a European thing. It tends to be some political theater, right? Because it's very difficult to do this in Europe because of supervisory boards and corporate governance, especially in Germany. So we do think that public debate tends to be more pronounced in Europe. But certainly in the U.S., if this price war gets worse, they're going to have to cut. They want to cut production before they cut price. So you could see it trickle into the U.S. as well. But we think that whole political theater seems to be, at this point, really based in Europe right now.
Well, one part of that is Ford going to Rachel Reeves, the Chancellor of the Exchequer in the UK, asking for more subsidies. Is subsidies the answers to basically move these EVs off lots?
Yes, and yes. The reason why European BEV sales actually going negative this year, which is surprising, is because Germany especially and other countries pulled their subsidies away at the end of last year. That's the key driver of BEV sales in Europe. As you guys know, next year, 2025, is the big CO2 regulatory cliff. These companies have to sell BEVs it doesn't look like that 2025 cliff is going to get delayed. So the answer is European governments have to step in and push incentives, and that's why the European OEMs, the car makers, want the incentives. They're not calling for the delays, not all of them. They really want the incentives to come back. People want EVs in Europe. That's not the issue. It's just the pricing is just too high.
When it comes to the European market as well, we're supposed to get those tariffs tomorrow on China. What are you expecting?
It seems like that there will be tariffs. And as you notice, it is stratified based on the OEM. And for the most part, they have worked, at least from the language we've heard from the European OEMs. I think only 1% of sales in Germany are Chinese EVs. So they seem to be working. The issue will obviously be what happens in 3 years or 2 or 3 years when the Chinese actually manufacture in Europe, the Trojan horse in there. I think that's going to be the bigger threat. But it looks like the tariffs will probably go through, stratified based on which OEM you're talking about.
Much to the chagrin of BMW and Mercedes-Benz, Tom, who do not want this to go through. They have said that vocally, in part, maybe only in part, to the fact that they have a huge proportion of their sales in China. What does the business model look like for German auto manufacturers if China puts up walls in response to the walls that Europe is putting up to their electric vehicles?
Yeah, it's definitely a net negative. I should note, though, that most of the production from the German OEMs in China is localized, right? It's through JV partners. But there certainly is a percentage, let's say 20, 30%, that's exported from Europe. So it's definitely a net negative. The bigger issue, I do think, is the domestic competition in China is intensifying. The domestic players are doing really well. And what we saw from the Mercedes profit warning is they were commenting on softness at the top end. That was not supposed to happen, right? Are Chinese consumers favoring their domestics, even at the high end? I think that's the thing that has the German OEMs maybe a little worried.
Tom, where does that leave Tesla in that market?
Yeah, I mean, look, Tesla's actually doing quite well from selling cars. But, certainly a tariff war is not great. We've seen what happened to Tesla numbers in Europe just this past quarter because of tariffs. It's already impacting their numbers. So, look, it's definitely a net negative. They don't want a trade war. But, as you commented from my report earlier, I don't think folks should be really caring so much on Tesla deliveries quarter to quarter. It's really more about other things, right? Autonomy, energy storage. And by the way, they're going to collect some regulatory credits because of the CO2 cliff next year. Because I don't think a lot of these OEMs in Europe are going to be able to make the CO2 targets if the EV sales continue at their pace and if we don't get substantial incentives from the governments.
Interesting. Tom, we've got so much to talk about through the next 12 months. Looking forward to doing it again soon. Tom Narayan there of RBC on the auto market. We've said repeatedly on this programme, China, the most competitive market anywhere on the planet. It's got to be one, the automakers there. And the consumer preferences are shifting big time.
And they're shifting in part because the government is basically saying, shift them. And by the way, you want to buy the national champions. Question is where it leaves international players. I'm glad you asked about Tesla. Where does this leave Tesla? And ultimately, Tom's saying, look, the proposition there is not as a car manufacturer. You have to be betting on some of this other technology that really is what will drive this company, no pun intended, to the valuations that it has.
The politics of all of this in Europe. How many times have we said either they're going to cut capacity and cut it big time, or you need big-time state aid? It's kind of one or the other right now.
And it's kind of the moment that they have to determine which it's going to be. Because if you think about BMW and Mercedes, I understand Tom's point that you've got a lot of domestic providers that are manufacturing these cars. Nonetheless, there must be a reason why they have come out so vociferously against any kind of tariffs, any kind of walls for Europe to put up to Chinese electric vehicles.
It's been a massive year for that industry, that's for sure. Coming up next on this programme, jobless claims data 5 minutes away. We'll break it down right here on Bloomberg TV with Bloomberg's Michael McKee. We'll catch up with Lindsey Piegza of Stifel on the economy, and we'll speak to Jack Manley of JP Morgan, here to react and look at the markets from New York. This is Bloomberg. 60 minutes away from the opening bell. Cash open just around the corner. Equity futures coming back just 0.1% on the S&P, down 2 on the Nasdaq on a Russell, down 0.4% in about 15 seconds time. Jobless claims data. Mike McKee's going to break that down for you. The scores in the bond market look like this going into it. The 2-year 365, the 10-year 380.56. The number we're looking for in our survey 221. The previous week 218. With economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, and it's one of those mornings where the data are slow coming out, but here we go. 225,000 jobless claims last week. That's up from 219,000. The 219 was revised up by 1,000 from 218. So basically, we're in the ballpark of where we have been for some time now, and it really doesn't tell us anything about where we are in terms of the overall labor market, other than companies are not letting people go. Now, this is obviously a seasonally adjusted number, so we'll see. I've got to get the release pulled up here to see if there is a big change in the unadjusted numbers.
Will you stay with that? I'll go through the price action. Yields are still higher. They stay higher, up 2 basis points on a 2-year, on a 10-year up by 2 as well. In the equity market on the S&P 500, some muted losses, mild losses going into this print. We stay that way. We're down about 0.1% on the S&P 500. On the Nasdaq, we're down 0.2. If you put the data together this week, we haven't solved the conundrum. This is it. The ultimate dilemma for economists right now on Wall Street, trying to figure out what happens next. The quits rate is lower. The hiring rate is lower. But the layoff still remains low. So if you've got layoffs low, jobless claims low, we're having the same debate, Mike, we've been having for months.
Exactly.
And layoffs inevitable.
Well, if you're going into recession, they're inevitable. Right now, the unadjusted data show a decrease of 1,000 in unadjusted jobless claims, which suggests that we didn't see any kind of bump in layoffs that were smoothed out here. Continuing claims, 1,826,000, are down 1,000 from the week before. So the jobless claims side of the employment ledger does not suggest that we're seeing a labor market deterioration.
Do we care about challenger job cuts, which also came out earlier this morning? I mean, is there any signs that we are seeing on the margins, layoffs just picking up just a little bit? Or do you think that in general, we're sort of in this, as Nela Richardson said, this sort of economist's nirvana for the moment that can be pushed in either direction?
Well, it's a kind of a difficult situation to analyze challenger for a couple of reasons. One, they are worldwide. U.S. companies, but their worldwide labor force. And a lot of the job cuts are done through attrition rather than layoffs. So they don't really give you a clear picture of what's going on. When you see a change like that as well, you notice they're up by 53%, the job cuts, but also we had Amazon announcing it's going to hire 125,000 seasonal employees and target 100,000. And so those aren't incorporated into it. There's a lot of churn in the labor market. So Challenger doesn't really provide that much useful information.
Jobless claims this morning, 225, the estimate 221. The previous week, a revised 219. Into tomorrow, payrolls. The estimate in our survey, 150. The previous month, 142. Mike McKee, thank you, sir. With us now is Lindsey Piegza of Stifel. Lindsey, let's talk about the numbers that just came out. Anything to fear? Anything to worry about looking at the labour market data through this week?
Really not yet. The jobless claims seem to be pretty steady. We have seen a little bit of weekly volatility, but nothing to indicate a sizable directional trend. Right now, we continue to see that the labor market remains tight-ish, with some indications of cooling momentum. But again, that cooling suggests the data is simply moving more towards a neutral state as opposed to an indication of mounting weakness as we look further to the end of the year and turn that page into 2025.
Where do you get any degree of confidence that we'd stabilize in this state at this level?
Well, I don't think we're going to get much confidence from jobless claims per se, at least not the weekly data that we've stabilized. Big confidence is going to come from more improvement or more stabilization in the non-farm payrolls report. So Friday is going to be a very key driver, not only for confidence for investors, but for the Fed officials looking to make that determination of what's the appropriate next move for November and December. If we see more indications of cooling momentum, I think that's going to bolster the case for a larger, more aggressive second round 50 basis point cut. But if we see more steady conditions, if we see more stabilization, that's going to make it pretty difficult, coupled with earlier uneven inflation data from the PCE, to justify anything beyond a 25 basis point cut. And should we see the numbers come into the upside, I think the Fed may be willing to sit on the sideline and take a pause in November.
Forgive me, because I've been conditioned by experience, Lindsey, but every time we're heading into a non-farm payrolls, everyone says this is going to be decisive. It's going to tell us where we are in terms of on the brink of some sort of deterioration or some, steady as she goes type of state. And then it comes out and people find 15 different narratives to justify within that same data. Lindsey, why should this be any different?
Well, I think, again, it's not the end all. It's not the deciding factor for November, but it is one of the key pieces. We have a handful of key data points between now and November, and the Fed is going to look at them in their entirety. So coupled with the idea that the PCE, yes, it's a key driver, but it was mixed. It was uneven. The headline retreated. The core showed further upward momentum. Now, we're going to turn our focus to the labor market. If the labor market comes in very clear to the upside or the downside, that's going to be a very key driving factor to that decision. But again, if it comes in mixed, the Fed is likely to say, well, we need more indications. We're going to wait for a next round of inflation. We're going to wait for the next round of the employment data. So it's not that one data point is going to make the decision, but each of these data points becomes increasingly more important as the picture is not yet clear as to what the Fed should be doing and the size and the momentum of these policy adjustments that the market is anticipating.
Lindsey, how much salt, though, needs to be thrown on the next data point of the non-farm payroll report on November 1st?
Well, there is going to be some adjustments that have to be taken into account. Of course, the port strike, of course, the hurricane, all of these events are going to provide additional volatility. But it's likely that we do see most of that volatility not necessarily hit the November report. It may take an additional month to come through. That being said, if we did see that type of distraction or volatility, the Fed can also look through that. So yes, there is some amount of we need to look at the data point with a grain of salt, given the underlying factors, these one-off effects. But the Fed is smart enough to look through that. They're going to see the underlying directional momentum. And again, that's going to help decide where the Fed policy needs to go from here.
What's your best guess for tomorrow?
I think we are going to see something similar along what we saw last month. I think 140, 150,000 is very reasonable, keeping us on par with, again, the pace of job creation, raising the 3-month average closer to around 130,000. But the unemployment rate still steady around 4.2%, well below what the Fed has designated as that full employment range or the sustainable level of joblessness. So I think we get a somewhat favorable report still indicating tight-ish conditions and still indicating the need for a very patient, tempered, controlled reduction of rates as, again, inflation, their job of reinstating price stability has not yet been met.
Lindsey Piegza of Stifel. Lindsey, thank you. Essentially the message we got from the chairman earlier this week. We're in no rush. We're not in a hurry.
Which was the reason why people thought, well, maybe we got a little bit ahead of ourselves. Then, of course, you have Andrew Holtenhorst right on cue, comes out with this. Jobs data to give direction, basically saying low initial jobless show layoffs have not picked up, but that may change. He continues to predict 70,000 for tomorrow, which
downside
definitely
risk.
Yeah, exactly. Which, is a different scene.
Mr. 70K over at Citi. Unreal. With us around the table, Jack Manley of JP Morgan. Far more bullish than that. Jack, it's good to see you.
Good to see you too.
Layoffs, they're low. Are they inevitable?
I'll echo your sentiment, right? Which is that it kind of depends where you're looking in this economic cycle. I think at the moment the business confidence is there to keep people employed, and the layoff numbers that we've been seeing on a weekly basis have been reinforcing this narrative that the labor market is quite tight for where we are in this economic cycle, right? People are not losing their jobs. Payroll gains are still positive. The unemployment rate is moving higher because of a supply side problem, not because of a demand side problem. I'm not particularly worried about layoffs at the moment, but talk to me in 6 months. It could be a completely different story.
So we had the conversation this morning whether a good number would actually be good news for this equity market. I sense from what you're saying it would be.
We'll see about that. I actually think we're back in this kind of like perverse environment where bad news is good news. Which
we flipped again.
I think we flipped again because when you look at what's going on, I mean, this is like it's unhinged, right? So the market right now, the market right now is calling for what 125 basis points of cumulative easing this year. So another 75 basis points after what the Fed has already delivered back in September. And when John, you mentioned earlier some commentary from the chairman that they're not in any rush. There's no real worry. I mean, how do you adjust the dot plot from 25 basis points to 100 basis points of easing over the course of 3 months, and then add another cut to the cycle by the end of 2026 and say, hey, we're not worried about anything? That to me is telling, very telling about how the Fed in particular thinks about what's going on with labor. And what's even crazier to me is that in the aftermath of that June summary of economic projections, right, the Fed tells us 25 basis points. The market says you're full of it. It's going to be 100. Then the Fed comes out and says, okay, you're right. It's going to be 100. And the market says, no, it's actually going to now be 125 or 150. If we see payroll gains come in tomorrow at 150,000, if we see the unemployment rate stabilize at 4.2 or even move a little bit lower, I think that narrative for 125 basis points of easing continues to deteriorate. And when we talk about inevitabilities here, John, I don't know about an inevitability with layoffs, but at some point, this game of chicken between the market and the Fed is going to come to a head. At some point, somebody's going to be right on this one. And my guess is the 100 basis points is probably closer to the truth than the 125. And as soon as markets come on board with that, you got volatility all along the curve. You got volatility in the equity market.
So just let's stay with the whole idea of now good news is bad news for equities in particular. That's basically what you're saying, right? That basically you start pricing out interest rate cuts that are outsized. That is going to be risk off. Okay. I guess I'm trying to wrap my head around something when really everyone was telling us that if companies are in a good economic situation, that is good for these companies. If inflation is a little bit hotter, that is good for corporate earnings. Doesn't it all come down to corporate earnings more than anything else, and we're just basically rearranging the deck chairs ahead of earnings season?
Without a doubt. I mean, it's earnings and in particular what's going on with margins. And I think the differentiator in this conversation has to be the market versus pockets of the market, right? We know that the market, by and large, has been driven by a very small handful of names. That story has changed a little bit in recent months. But generally speaking, driven by a very small handful of names, gassed up on this idea that, AI is going to fundamentally transform the world, lofty valuations, pretty impressive earnings expectations, but the S&P 493 or whatever it is that you want to call them are much more fairly valued. And so I think if we're looking at the market in aggregate and we're worried about valuations in aggregate, then this change in expectations around interest rates may put a little bit of downward pressure on the overall entity of the S&P 500. But that doesn't mean that the rotation that we've been seeing in the market is not durable, because exactly to your point, Lisa, the overall macro trends, I think, are actually quite supportive. You have cooling wage pressure, which is good news for corporate America. You have easing inflation. I would agree we're not completely out of the woods just yet, but I think with inflation stabilizing, that's good news. And we have falling interest rates. And if that's 100 basis points or 50 basis points, anything's better than 0 basis points. And that's all good for a broadening out, I would say, of profitability.
So basically, this is short-term versus long-term. That short-term good news is bad news for the markets just simply because of where we've gone with valuations. But over the longer term, if the economy is stronger, even with fewer rate cuts, you still see this rotation into the other 493, into small caps, even potentially continuing.
That's exactly right. And I think the one other thing I'd sort of add to that story that ends up being a little bit confusing is we see an economy, right, that is very clearly cooling off relative to above trend growth in the back half of last year. And I think the labor market is an excellent leading indicator of exactly where that coolness is coming from. How can you make the argument, right, that a slowing economy is going to be better news for the companies that haven't been doing well? And I guess my pushback would be, if the U.S. economy grew, 4.5% annualized in the back half of last year, and these companies couldn't do anything, then I guess the proof is in the pudding, right? That higher interest rates, that hot inflation, that warm wage pressure matter more than overall economic activity, than GDP growth. So a cooler economy that avoids recession, right? I mean, that is like the biggest thing we have to point out. If there's a recession, this story changes. But as long as there's no recession, then all those things that I mentioned earlier, that kind of trifecta for profitability, it is great news in the long term, and all the stuff we're dealing with right now is noise over the short term.
Do you think we get less noise or maybe more clarity after the election, this narrative that a lot of companies are holding back on hiring because they want clarity on November 5th?
I think that normally that's how we would think about things. I mean, when we talk about elections and politics in general with our clients, we always like to say, elections are profound sources of uncertainty. And markets, more than anything, hate uncertainty. Markets don't care who wins, right? They just want to know who's in charge. They want to know the composition of governments so they can plan for or around any potential policy change. And so, in general, a good kind of rule is election day happens, you know what government's going to look like, and then all of a sudden you're kind of back off to the races. I would say that this year, I mean, I know this time it's different or whatever, you shouldn't say that kind of thing, but this is clearly a very unusual year. There are a lot of other headlines swirling around out there. And I would make the argument that the election is not the thing that everybody is most concerned about at the moment. Maybe it's tied with a few other things, but it's not like, once that's over, everything else is back to sunshine and rainbows. There's plenty of other stuff for businesses and consumers to be worried about.
Jack, it's good to see you.
Great
Thank
to
you,
see
sir.
you too.
Appreciate the update. Jack Manley there of JP Morgan. Jobless claims. No bad news here. No bad news here. Equity futures right now down 0.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Recapping that labor data, U.S. jobless claims picked up slightly last week. The data is at a level consistent with a limited number of layoffs. Initial claims increased by 6,000 to 225,000, higher than the medium forecast in a Bloomberg survey of economists, which called for 221,000 applications. Meanwhile, continuing claims were little changed. Starbucks is bracing for climate change, the company announcing plans to buy 2 new research farms in an effort to make coffee more resilient. Starbucks said a farm in Costa Rica will look into solutions, including how technology can help farmers. Meanwhile, the other farm in Guatemala will replicate the challenges facing the small farms that make up 97% of its supply chain. In September, extreme dryness in Brazil sent prices for beans favored by Starbucks to their highest level since 2011. And people familiar with the matter say Miami Dolphins owner Stephen Ross is working on a deal with private equity firm Ares Management and billionaire Joe Tsai. The deal would include stakes in the team and other assets at a valuation of $8.1 billion. A potential deal would be the first private equity transaction after the league changed ownership rules earlier this year. The Dolphins, the NFL, and Ares declined to comment. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the former New York Fed President, Bill Dudley. That's just around the corner from New York. This is Bloomberg. Around about 40 minutes away from the opening bell, equities pulling back by 0.2% on the S&P 500. As we count you down to the cash open, the trading diary for the rest of the week, the calendar looks like this. At 10 a.m., factory orders, durable goods and ISM services. Then at 10:40, more Fed speak from Kashkari and Bostic. And tomorrow, it's payrolls Friday, the next big data point for the Federal Reserve. Elsewhere on the Federal Reserve, the former New York Fed President Bill Dudley, in a new Bloomberg opinion column, writing this: I've been too pessimistic about the risks of a so-called hard landing for the U.S. economy over the past few years. Although most of my conclusions that led to that view were correct, such an outcome remains very much in doubt. Bill joins us now for more. Bill, welcome back to the programme, sir. It's been quite a journey for you, an intellectual journey over the year so far. I want to go through a couple of headlines and you help me understand why you've changed your thinking somewhat. It was only back earlier this summer where you said, I changed my mind, the Fed needs to cut rates now. Before the Federal Reserve meeting last time around, you said they need to go big now. I think they will. They did. This morning, my hard landing forecast turned out to be wrong. Bill, just walk us through how you're thinking about things currently and what kind of policy this backdrop needs.
Well, my original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a 0.5 percentage point, trigger the SOM rule. Check. But the SOM rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. It's still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing it all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession, that's going to be tough to keep on that nice edge.
Bill, what are you expecting for tomorrow?
I think it'll be a decent payroll employment report. I mean, I think the estimates are around 140,000. That seems like a reasonable estimate. We have to remember, though, the payroll employment has a big standard error around those estimates. So you could get something like 80,000 or you get something like 200,000. And it really wouldn't tell you for sure that the economy has actually changed momentum.
Bill, how difficult is that November 7th meeting going to be, considering how messy the data might be, considering we might not have an outcome from the election? Can you think of a time like this one that they're going into in the next month?
Well, the particular awkwardness is that there'll be another payroll employment report during the blackout period right before the FOMC meeting. I think that most of the momentum is for 25 basis points at this point. Powell basically foreshadowed that in his speech. The fact that you had all these people in the summary of economic projections that only had one more rate cut in their forecast after the last meeting also tells you that it's probably not going to be 50. So I think the basic story is still intact. Risks to the labor market are greater than the risk to inflation. Monetary policy is tight. We're still quite a ways from neutral. So 25 basis points is the most likely scenario in my view at this point.
Bill, we had Adam Posen on earlier from the Peterson Institute, who said that the Fed should be vocal about the fact that they're considering the deficit and potential tariffs as a potential inflationary pressure heading into 2025 and a reason to cut less. What do you make of that? Not necessarily the Fed weighing in on that particular issue, but being more cautious ahead of next year because of it.
In my experience, the Fed doesn't, set policy today on things that might or might not happen in the future. I think they wait till those things either materialize or not. And so I think that the idea that the Fed wouldn't ease because they're worried that the election could result in a certain outcome that would lead to higher tariffs and higher inflation, I don't think the Federal Reserve would hold off because of that.
Bill Dudley, appreciate it, sir. As always, the former New York Fed President Bill Dudley there on his latest piece, How My Hard Landing Forecast Turned Out to Be Wrong. You can find that on Bloomberg Opinion. Bill's lived this going into the 2016 election, and coming out the other side, we were all talking about tax cuts in Washington, and the Federal Reserve just had to wait to see the campaign promise to become legislative reality.
Right, and they're going to have to wait this time around, too, and essentially everyone's saying they're not going to really weigh in on this. That said, just taking out tariffs, taking out the potential for an expanding deficit, there is an issue of whether we have underpriced the inflation risk, given the fact that everyone is saying this economy looks very different than it has in the past, and you're seeing very easy financial conditions. And that, I think, is a real important takeaway.
It's a debate that continues. Coming up tomorrow, here's the lineup for you. Priya Misra of JP Morgan, Alan Zentner of Morgan Stanley, Nadia Lovell of UBS, and Mohammed Al-Own of Queen's College, Cambridge, and a whole lot more. The lineup is absolutely stacked as we count you down to payrolls Friday. This is the number we're looking for. In our survey, the median estimate 150. The last number 142, and I imagine it will solve absolutely nothing as we go into the Federal Reserve decision next month and a big election still to come. From New York City this morning, good morning. This was Bloomberg Surveillance.